Good afternoon and welcome to the joint general session of the ISO Board of Governors and WEIM governing body. Please note that this meeting is being recorded and all attendee lines are currently muted to reduce background noise. When we get to the public comment portion of the call, you can please press the raise hand icon on Zoom or #2 on your telephone keypad to enter the public comment queue. With that, I'd now like to turn the call over to Roger Collington. Please go ahead.
Thank you, Silas, and good afternoon, everybody. And thank you for joining the joint ISO Board of Governors and WEIM governing body meeting this afternoon. Let me start out with our roll call, and then I will turn it over to our chairs for welcoming comments. Start alphabetically. Vice Chair Borenstein.
Here.
Chair Campbell.
Here.
Member Decker.
Here.
Governor Edo. Joe, are you on? Not hearing. We'll continue and circle back. Governor Galitova.
Present.
Vice Chair Konzioka.
Here.
Governor Leslie.
Here.
Member Prescott.
Here.
Chair Shorey.
Here.
And Member Wagner.
Here.
Still don't see Governor Edo, but we have a quorum on both bodies and we can continue at this point. So let's go ahead and move forward. The first item on our agenda is for the chair's welcoming and then public comment. So let me turn it over to you, Chair Campbell.
Sure, I think actually Chair Shorey's up first this time.
Oh, I'm sorry.
That's all right.
You know, I'm a creature of habit. I apologize. Chair Shorey, I did not mean to miss you.
No, that's okay. We're trying to be fair and rotate everything. So I appreciate that, Andy. At any rate, I will just extend my welcome to all the participants, the staff, all of my fellow board members and the members of the governing body. We have a very substantive agenda this afternoon with a lot of extremely important issues, and I'm actually pretty excited to be getting both the pathways update and the discussion that we'll have on how onboarding for EDAM is working. So we will definitely be sure that we get through this agenda so that we're able to tackle everything. But thank you everyone for participating, and I look forward to the meeting with you all today.
Great. Thank you, Chair Shorey. And now it's your turn, Chair Campbell.
Okay, thank you, Roger. And I'll just echo good afternoon. Thank you for attending today's meeting. I'm looking forward to jumping into this very substantive agenda in addition to the items Chair Shorey mentioned. I'm very much looking forward to the load conformance discussion. So we need to keep that caffeine going until 4 p.m. plus to that item. But thanks everyone for being here. I'll hand things back over to Corporate Secretary Roger Collington.
Thank you. Thank you, Chair Shorey. Thank you, Chair Campbell. The next item we have is our public comment, and this is general public comment for items that are not specified on the agenda. And operator, if you can check the lines for public comment, please.
If you would like to speak under general public comment, please press the raise hand icon on Zoom, or if you are dialed into the phone only line, please press #2 to enter the queue. There are no comments in the queue at this time.
Thank you, Silas. And I will note for the record that I do see that Governor Edo is on the line. Joe, can you hear us?
Yes, I can. I apologize. I had some kind of internet connectivity issue just a second ago.
No worries. We all understand that these days. Let's go ahead to agenda item number 2, which is our decision on the March 20th, 24 joint general session minutes. And can I have a motion to approve those minutes, please?
So moved.
I'll second.
And I'm sorry, was that Rob?
I'll second. Yeah.
Thank you. And I'll go ahead and take the vote alphabetically. Vice Chair Borenstein?
Aye.
Chair Campbell?
Yes.
Member Decker,
Aye.
Governor Edo,
Aye.
Governor Glitova,
Aye.
Vice Chair Konzioka,
Aye.
Governor Leslie,
Aye.
Member Prescott,
Aye.
Chair Shorey,
Aye.
and Member Wagner.
Aye.
Thank you. I caught you at a bad time, mid sneeze, I think. I'm sorry. The motion does pass with a full vote. So thank you, everyone. Next item is agenda item number 3, and I will turn it over to our CEO, Elliot Manger, for his CEO remarks. Elliot?
Thank you, Roger. Chair Shorey, Chair Campbell, members of the Board of Governors and the governing body. It's great to see all of you this Wednesday afternoon. It's already been noted we're going to be having a very substantive round of conversations this afternoon. I wanted just to start off just acknowledging some really, it's just been a very positive and productive last couple of months, just tremendous progress on resource adequacy, transmission, just continuing to see the EDAM footprint growing, and just really wanted to start out with a big round of thanks. Just there is a lot of gratitude to go around right now. Just thinking about the items on our agenda today, we're going to be dipping into a very important issue around the soft offer bid cap. A tremendous appreciation to the RIF and to the many stakeholders who've engaged on this issue. A great input from the Department of Market Monitoring, the Market Surveillance Committee, and of course the CAISO staff that have looked to fit a line to this important topic. I'm also really looking forward to the briefing on the West-Right Governance Pathways Initiative from some of the members of the launch committee. The progress that this group has made and the sort of spirit of stakeholder engagement really is inspiring. Really appreciate their work and looking forward to that presentation later this afternoon. Also, of course, now that we are really rolling up our sleeves and getting into the heart and soul of implementation on the extended day-ahead market, looking forward to hearing this afternoon from Christine Rock from PacifiCorp about the onboarding, the update on implementation. That is something that is obviously of laser focus for all of us. And then, as those have mentioned, we're all going to continue to drink our cups of coffee into the afternoon and get a really, I think, very informative briefing on load conformance, including the residual unit commitment adjustments. This is a topic that I know is of interest to many of us. So just wanted to again express my thanks to just our many partners throughout California and across the West, and to the team at CAISO who's just working so hard right now on so many important issues. So looking forward to the discussions, and thanks again, and back to you.
Sorry, I was on mute. Thank you, Elliot. The next item is agenda item number 4, which is our decision on rules for bidding above the soft offer cap price formation enhancements. And before I turn this over to Becky Robbins or to Anna McKenna for her introduction, let me just note for the record that we did receive 4 letters of comment that were provided both to the board and to the governing body. And that was a letter from the WEIM Regional Issues Forum, signed by the 10 sector liaison, a letter from Bonneville Power Administration, a letter from Seattle City Light, and a letter from Western Power Trading Forum. And again, for the record, those have been all provided to our governing body as well as to our board. And with that, let me turn it over to you, Anna.
Thank you, Roger, and good afternoon, Board of Governors, governing body members, members of the public, and colleagues. I'm very happy today to introduce you management's proposal for changes to the rules for bidding above the $1,000 soft cap for storage and hydro resources. I'm Becky Robinson, the Director of Market Policy and Development, will walk you through the proposal. But before I turn it over to Becky, I wanted to emphasize that this proposal comes out of an expedited but thorough stakeholder process that we initiated early this year. We expedited the process in response to concerns raised by stakeholders regarding the potential limitations of the current rules to their ability to operate their resources effectively and to manage their intraday opportunity costs. And we did so also in addition to our own concerns regarding the grid operator's ability to ensure that these critical use limited resources are available during the hours they are most needed and avoid exhausting their use limitations. recognizing that these risks, when resources may be tight, are critical to all of us, we wanted to make sure we had a solution for this summer. So the two-part proposal is one that was developed with that in mind, and that we have determined is implementable by August 1st. And that's when we expect conditions to start heating up the most, but it's the soonest we could do given the circumstances. We very much recognize that there was simply not enough time to address all the issues that were raised, but we took the time to ensure that what was feasible for this summer addressed some immediate concerns, and we are going to be continuing to work with stakeholders for future enhancements beyond this summer. We also recognize that the speed with which we had to act has raised concerns for some with regards to unintended consequences. We have taken the time needed to ensure that the known issues were addressed, but of course there may be unknown issues, and we will have time as well, given the time frame that we've presented here, to actually test prior to implementation the proposed rule changes. And after go live, after we implement, we will be monitoring very closely for the performance of these rules to ensure that if there are any unintended consequences, we'll act swiftly. In the spirit of minimizing possible unintended consequences, we took the advice of the MSC and other stakeholders and modified our proposal to ensure that we had adopted a proposal, that we had for you a proposal that was necessary to manage the issues that we have identified, but did not openly present opportunity for unintended consequences beyond what was actually needed. But we recognize that for some stakeholders, they may not be pleased with this outcome, and we are regretful that we simply ran out of time before we had to complete our proposal for you. And we tried very much to balance the possibility of delaying a decision to consider another iteration of stakeholder comments against the benefit of getting a proposal before you in time to implement by August. So those are some of the challenges and items that I think preceded this proposal, but we think we have a nice set of proposed changes that will address some of the issues that have been identified. And with that, I will ask Becky to walk you through the proposal with greater detail.
Thank you, Anna. Good afternoon, Board of Governors and members of the governing body. With much anticipation, let's go ahead and get into this item for today. Next slide, please. All right, first, let's start with some background on FERC Order 831, which sort of establishes the landscape that we're operating within. So FERC issued Order number 831 in 2016 and established a new offer cap structure for ISO and RTOs. Before, there was just a $1,000 offer cap, but FERC had seen some instances where fuel costs, during winter events especially, supported offers in energy markets of over $1,000. And at that time, before this rule was in place, those costs just had to be paid through uplift rather than through market prices signaling those costs. So FERC issued this order to effectively increase the offer caps in some way. It allowed resources to offer above $1,000 and for offers up to $2,000 a megawatt hour to set prices, so long as the costs underlying those offers are verified. So it allowed this increase in the offer cap, but it tempered it by the cost verification requirement to protect against the exercise of market power and the $2,000 limit on offers for the purpose of setting prices provided an upward bound on exposure to higher prices. And while these provisions apply to all resource types in the order, the FERC order, as well as our cost verification process that we filed to comply with the order, did not specifically contemplate how to verify opportunity costs, such as we see now, and the cost for resources with a limited amount of energy, for which the cost of producing in a given hour may be the revenues foregone from not being able to produce in a future hour. And we have now seen instances, which is why we have been having this conversation with stakeholders the last few months, We've now seen instances of market results where resources had operational challenges managing their limited energy over the course of the day, at least in part due to their offers being limited to $1,000. Next slide, please. So just briefly to hit kind of a few summary points. As Anna mentioned, we launched this initiative in response to stakeholder concerns. We initially brought up this topic as part of our scarcity pricing sprint that we did in January, a series of meetings on scarcity pricing elements, as well as just pricing during tight system conditions. And we got resounding feedback from stakeholders that they saw this as an issue that merited prioritizing and escalating. And so we were responsive to that. And I will say at that point, it was, I think, it felt very unanimous. You know, we heard a lot of stakeholder input that we needed to address this issue, that there was a real problem to solve here. And so what we are bringing to you today is management proposal to modify market rules for resources bidding above the $1,000 megawatt hour soft offer cap. The proposed changes aim to improve market efficiency and reliability such that the energy will be available from resources when it is most needed. And we, as I said, when we initially started this, we had broad support, I would say uniform support even to address the issue, to work on the issue. As we have sort of narrowed in on the field of possible solutions and choosing a particular solution, we've seen and heard, that there's not unanimity in the particular solution, right? Some folks would prefer it one way, some folks would prefer it a different way. We hope that we think that we have struck a balanced approach in what we're bringing you today, and look forward to the questions on those points. Next slide, please. So the two identified issues that we really zeroed in on in the stakeholder process and our conversations with stakeholders are one, that resources with these intraday opportunity costs struggle to preserve their limited energy for the highest priced hours. And sort of another way, or a different version of a similar problem, is two, that these resources may not be able to maintain their day ahead market schedules when real-time prices exceed the soft offer cap. Next slide, please. Okay, so here are at bottom the two parts of our proposal today. The first part of the proposal is to remove the $1,000 megawatt hour cap on default energy bids or all resources in both the day ahead and real-time market. Now, default energy bids, you may know, we use those are calculations, formulas, to represent the costs when resources are mitigated and as part of the cost verification process for offers over $1,000. And we are comfortable that these calculations are reasonable representations of cost, regardless of whether the calculation yields a value over or under $1,000. And so that's sort of the principle for why we believe that this change is merited. And so this will allow resources to bid up to their costs, even if they're above $1,000 a megawatt hour. Now, what does this mean for different resource types? Let's take hydro first. For hydro resources, this is a particularly relevant reform. We did some analysis on these high price days where we saw prices and offers go over $1,000. And the hydro default energy bid, we saw, for a significant part of the fleet and in a significant number of those type of days, we saw the hydro default energy bid calculation go over $1,000. And so we thought this change on its own really does a lot of work to alleviate the issue that we've seen for hydro resources managing their limited water. And so that's good. We think, part one of the proposal is sort of all that hydro needs, at least at this point, in order to manage this issue. Now, what does this mean for storage resources? Just part one of the proposal. Still talking about just part one for now. So there are a couple of reasons why the first change is insufficient for storage resources. The first is that I mentioned the analysis that we did, which informed how we think about it for hydro resources. But that analysis looking at the storage default energy bid showed that that calculation on these tight days that we're talking about has only rarely yielded values over $1,000. And when it did, it was only for a handful of individual storage resources and not less than a quarter of the storage fleet, for instance. And so that difference and sort of what we saw with the analysis on these high price days, where it led us to conclude that this change on its own was not a meaningful solution for storage resources. And because of that, we said, well, we need a part 2 of the proposal. It is also the case that from a technology perspective, we are not currently equipped to use the storage default energy bid as a bid cap in either the day ahead or the real-time market. The storage default energy bid is different than other default energy bid calculations because it's a product of the day ahead market. And there is currently not integration between the relevant systems to use that storage default energy bid as a bid cap. We could work on doing that, but we determined we could not do that by August 1. So a couple questions to tease that point out. If a storage DEB calculation yields a value over $1,000 in the day ahead market, will resources that use the storage default energy bid be able to bid over $1,000? No. Will the storage resource still be optimized to charge and discharge in the most advantageous hours in the day ahead market? Yes. Can storage resources opt to use a different default energy bid formulation? Yes. There are other default energy bid formulations that are available if they would like to use those. And in which case, if those calculations yield values over $1,000, then those storage resources using those different default energy bids would be allowed to bid over $1,000 a megawatt hour in the day ahead market. And then finally, my last clarification question, in real time, if a storage resource bids above $1,000 and is mitigated and its default energy bid calculates a value over $1,000, will it be mitigated down to $1,000? No. We are able to use the storage default energy bid for the purpose of mitigation in the same way that we do today. So in the case of that offer over 1,000 and mitigation, and it's using the storage DEB, it will be, the mitigation will work as it typically does. They will be mitigated to the higher of their uncapped DEB or the competitive LMP. So on this point, as to how part 1 of the proposal applies to storage resources, we offered a clarification to the board memo a few days ago, a new footnote 1, in response to some stakeholder questions about the board memo. And we provided more detail there, but it doesn't change our proposal. It's consistent with the discussion that we had in the draft final proposal. All right, one last category of resources to talk about with part 1 of our proposed change, hybrid resources. So a hybrid resource is an instance where we have 2 different resources, such as solar and storage, operating or interfacing with the ISO market as a single resource. That's different from co-located resources, which operate as 2 separate resources. And for either of these, it can be wind and storage, solar and storage, different combination of things. But the key for a hybrid resource is that it's one resource ID interfacing with the market versus standalone storage or co-located storage paired with solar or wind, which looks like separate resources. So today's proposals do not apply to hybrids. Today's changes do apply to co-located storage resources. And the key difference with hybrids, a few things. First, hybrids are not currently subject to mitigation, and we do not have default energy bid calculations for them. You may recall that when we first started seeing storage resources in the market, those were not subject to mitigation either until they became a larger and more mature resource class. Hybrids are in a similar position now. We just haven't yet had the conversation about what a reasonable calculation of a hybrid resource's costs would be in order to come up with that default energy bid formulation. We've had some recent sort of questions about this application to hybrids, and we're happy to include hybrids in the conversation moving forward, but I did want to be clear that as of today, the proposal we're bringing you today does not apply these changes to hybrid resources. All right, let's move to part 2 of the proposal. Part 2 of the proposal would modify the real-time bid cap for energy storage resources to provide additional bidding flexibility. And again, this is because, as I said, for part 1 of the change, we really don't think that that's meaningful for storage resources. We just don't see the storage DEB values going over $1,000 when we need it to and in a meaningful way. So we're going to raise the real-time bid cap for storage resources in particular to a higher value. What is that value? It is the higher of the highest cost verified bid from a resource-specific resource, or the 4th highest hour of something called the maximum import bid price. Now, the maximum import bid price is an existing calculation that we have in the market today. It's based on bilateral hub prices, but gives them an hourly shape. So we're proposing to use the 4th highest hour as a storage bid cap because the battery storage we have today is almost exclusively 4-hour storage resources, and allowing them to bid up to the 4th highest hour generally means they'll be dispatched in the highest 4 hours of the day. And this mirrors the calculation that we have today of the storage default energy bid, which allows them to bid up to the 4th highest day-ahead market price. But this change in particular, this part 2, recognizes that the maximum import bid price, those bilateral hubs, could produce prices that are higher than the prices we saw when we cleared the day-ahead market for the ISO-BA today. And so I did want to point out too that raising the bid cap to cover the highest cost verified bid means that storage resources will be able to bid as high as any other resource on the system. So for instance, if a hydro resource offers above $1,000 because their default energy bid permits that from part 1 of the proposal, then that offer can set the bid cap for storage resources. Now, I do want to address that applying this only in the real-time market and not also in the day-ahead market was a change that we made only last week to the proposal. And before that, we had proposed to apply this change to both the day-ahead and real-time market. And initially, why we had proposed to apply it to both is that while we sort of acknowledged that the problem was centered really in the real-time market based on the limited horizon of the real-time market, only looking ahead a couple hours, we think that having consistent rules between markets is a solid principle, promotes good market outcomes and price convergence, similar to the points that Dr. Pope made yesterday. However, the reasons why we decided to change the proposal to apply it only in the real-time market were that we continued to hear stakeholder feedback. We heard some stakeholder questions and concerns during the stakeholder meetings. But I will say, we continued to hear, and I'll say increasing levels of concern with applying the proposal to the day-ahead market and the concern for potential unintended consequences. And then we also had the Market Surveillance Committee opinion and meeting where they questioned the need to apply the proposal, they questioned the need to apply the proposal to the day-ahead market, given that the day-ahead market sees the whole 24-hour horizon all at once, and they pointed to potential unanticipated and unintended consequences, as well as the potential for storage resources to bid themselves out of the market in the day-ahead market. And they did not see a need to provide storage resources the ability to bid themselves out of the market. We recognize the change has perhaps made some people like the proposal more while disappointing others. We are open to continuing the conversation about the day-ahead market with stakeholders when we're not under the time crunch to get a solution in place for the August and September summer months. Ideally, perhaps we could have had another stakeholder meeting after the Market Surveillance Committee meeting to further explore whether or not to apply it to the day-ahead market, but then we wouldn't have been able to make an August 1 date, and we heard from stakeholders that we really needed a summer solution. If we could go to the next slide, please. All right, stakeholder engagement. So as Anna mentioned, we had an expedited but thorough stakeholder process based on that overall support that we heard initially to move quickly. We had 5 working group meetings and opportunities for written comments. I think as we've already touched on, we had broad support that there was a suboptimal dispatch issue to work on. And we had a lot of support, especially early on, from stakeholders supporting getting a solution in place for this summer timeframe. Now, I do want to acknowledge that as we've sort of gotten closer to the where we are today, we've also heard from some folks that we perhaps moved too fast on this issue. And I think we tried to strike a balance, but we also felt like it was important to bring you all a proposal today for your consideration. Key points of divergence that we heard from stakeholders. As I just mentioned, speed of the initiative. Day ahead versus real-time applicability. We talked about that a bit already. And the approach for representing opportunity costs using that maximum import bid price. Overall, we felt like we assessed the feasibility and proposed a balanced policy considering stakeholder input and implementation constraints. I also want to mention that some stakeholders suggested that proxy demand response resources should be in scope for this summer, or should be in scope for this issue. But ultimately, we felt like there wasn't sufficient information about the nature of such opportunity costs to merit inclusion at this time. And just another point on the speed of the initiative and whether urgency is merited. We have heard from several sources that, you know, it's not a great hydro year for the Pacific Northwest. We've got the NOAA and the Drought Monitor and U.S. Department of Agriculture data identifying that the Pacific Northwest and Southwest Canadian snowpack remains well below normal. There are drought conditions currently present across large portions of British Columbia, the Pacific Northwest, Northern Rockies, and parts of the Desert Southwest as well, and below normal rainfall in many of those areas expected between May and July. So little opportunity to refill the reservoirs from that perspective. We've also heard from the Department of Market Monitoring as well, sort of questions as to whether the bid cap is the problem for the suboptimal dispatch issue that we've seen on these days. And there is data showing that for storage resources on these past tight days, not all of those storage resources were bidding at the bid cap, right? So through that lens, it wasn't necessarily, some of them might have been dispatched off of their offer because they were economic, and they weren't necessarily already raising that offer as far as they could to prevent that from happening. And we recognize that, but we think it's still true that storage would not have been able to bid high enough to preserve its state of charge on those days. And today's change is not sufficient on its own to have state of charge when we need it. It's true that we do need storage resources to bid to preserve that state of charge if needed, but we have to enable them to be able to bid high enough to do so in the first instance. We also think that through this conversation we've had over the last several months, storage resources have learned more about the relevance of their bids during these during these conditions. All right, if we could go to the next slide, please. Future work. So we will plan to continue collaborating with stakeholders on further enhancements and monitoring the impact of today's proposal. I know that Anna touched on the monitoring point in her opening comments, noting that we do, daily validate and monitor the market results. And so I want to emphasize that activity occurs and will continue, especially in, on these tight days where we see very high prices. And then we also have some near-term related but independent work items, two in particular. So first, on the maximum import bid price calculation, we've heard concerns. I'll say independent from the proposal before you today, but we've heard some concerns from both the Department of Market Monitoring as well as the California Public Utilities Commission on how the maximum import bid price is currently calculated, specifically the shaping factor that translates that multi-hour bilateral hub price into an hourly shape for the day. So we've been having conversations about this and are committed to address this item. Sort of, again, this is an existing calculation that we use today in the markets. So regardless of today's proposal, if there's a problem with that calculation of that shaping factor, we need to fix that. And we are committed to do so. And based on the outcome of that stakeholder engagement, we'll propose any further enhancements to the maximum import bid price as needed. And I'll note that we do have a meeting on the calendar May 28th to talk about that shaping factor for the maximum import bid price. So another near-term related but independent work item is on storage bid cost recovery. So the Department of Market Monitoring has also raised concern that the proposal today could increase the unwarranted bid cost recovery payments to storage resources on days when the $2,000 megawatt hour hard cap is in effect. Because the concerns about unwarranted bid cost recovery payments to storage exist regardless of the changes proposed in this memorandum, that we're proposing to you today, we are initiating a stakeholder process to consider enhancements to bid cost recovery as it applies to storage resources. And then finally, long-term improvements that we talked about with stakeholders, and the stakeholder initiative identified as potential further work that we could continue to explore. Several items here. The reference level change request process, which is the way that a resource can sort of ask for an offer, ask to be able to offer over $1,000, sort of just based on their particular circumstances and costs. Default energy bid calculations, such as the storage default energy bid in particular. An opportunity cost for demand response resources. I would also include here, as I mentioned before, we've had some questions about hybrid resources, and I think we would include that in conversations going forward as well. Next slide, please. All right, in conclusion, we recommend approval of today's proposal. We think these changes are critical for improving market efficiency and optimal dispatch during tight conditions. We think that implementing for this summer, specifically, we're targeting an August 1 date, which builds in 60 days for a FERC filing. We think that that's crucial to address stakeholder concerns. And we think that ultimately the proposal balances the need for timely improvements against feasibility and stakeholder input. And ultimately, we think this is an important step forward in evolving market design for a transforming grid. So with that, happy to take any questions.
Thank you, Becky. Let's hold questions at this point, and we will move to, we have Adam Swadley from DMM to comment on behalf of DMM, and then we'll have an opportunity. We have DMM, then MSC, and then we'll have an opportunity for questions. Adam, are you available?
Yes. Good afternoon. I'm here.
Thank you. Proceed, please.
Good afternoon, Chair Shorey, Chair Campbell, governors and governing body members. Thank you for the opportunity today to share DMM's views on the proposed changes to rules for bidding over the soft offer cap. As DMM detailed in our public board memo on this topic, we support the first element of this proposal to increase the cap on default energy bids to $2,000 per megawatt hour. We understand that the proposal to increase the cap on default energy bids will primarily provide additional bidding flexibility for hydro resources that have intraday opportunity cost. We support that and recognize the proposal may also benefit other resources that have cost exceeding $1,000 per megawatt hour. We also continue to support further enhancements to default energy bids for resources facing intraday opportunity cost, including enhancements that would allow these to be more dynamic from hour to hour. But we recognize that these kinds of changes are beyond the scope of this initiative. We do not oppose the second element of the proposal, which is to establish a daily bid cap for energy storage resources that can exceed $1,000 per megawatt hour on days with hours where the $2,000 per megawatt hour hard offer cap is in effect. We conceptually support the idea of storage resources reflecting opportunity cost and bids. Early in the stakeholder process, we supported a targeted approach that would allow storage resources to reflect elevated opportunity cost in hours where appropriate, such as the hours leading up to the critical peak net load period. However, this type of targeted approach was not feasible by this summer. The proposed approach to allow a higher bid cap all day will allow bids that could significantly exceed intraday opportunity cost in many hours. And so given that and analysis that we've done on actual market bidding data from high price days, we question the urgent need to proceed with a quickly developed interim approach for storage resources by this summer. And we note that there may be risks associated with implementing such changes. As part of this stakeholder process, DMM analyzed real-time bids to discharge energy that were submitted by batteries on a sample of high-price days in the recent past, with the goal of assessing, what the role of the $1,000 cap may have played in preventing the battery fleet from being more fully charged going into the critical net load hours. As highlighted in our stakeholder comments and board memo, this analysis showed that at most 17 to 20% of battery storage capacity was bid at the current $1,000 per megawatt hour offer cap on these days. So this suggests that in the past, at least, the current bid cap has not been a significant cause of battery fleet not being fully charged going into the peak net load hours on critical days. On these days, the fleet has not been fully charged, in part because of bids under the $1,000 cap, not because of bids being limited by the $1,000 cap. So consequently, we're not sure how much additional battery capacity will be preserved going into the peak net load hours on critical summer days by increasing the bid cap. Ultimately, within a market framework, it's very difficult to expect all battery operators to foresee real-time market prices and submit bids such that the battery fleet will be optimally charged and discharged when most needed and most profitable on the most critical days of the year. We'd also like to note that the current bid cost recovery rules for batteries do not deter and can actually provide economic incentive for batteries to discharge in a manner that's inefficient and not aligned with system reliability needs. Raising the bid cap on some days may exacerbate this cause of bid cost recovery. The day-ahead market's 24-hour optimization does a good job of establishing schedules for charging and discharging battery fleet that are optimal from the perspective of resource profitability, economic efficiency, and system reliability. However, in the real-time market, bid cost recovery rules significantly reduce or can entirely eliminate the financial risk associated with those schedules becoming infeasible due to real-time stated charge limitations. There are a number of situations where batteries may receive inappropriate or inefficient bid cost recovery payments, and DMM has recommended and supports the ISO pursuing market design changes to enhance bid cost recovery rules for storage resources. But until these issues are addressed, allowing storage resources to submit higher energy bids, even when they may be aligned with intraday opportunity cost, could further increase unwarranted BCR payments to storage resources on days when the $2,000 per megawatt hour hard cap is in effect. Finally, we do note that the current calculation of the ISO's maximum import bid price appears incorrect, specifically the shaping factor. DMM highly recommends fixing the calculation of the maximum import bid price by this summer and before extending its use to other areas of the market. We believe that fixing this issue should be a higher priority than the proposed changes for increasing the bid cap for storage resources. So in conclusion, DMM supports raising the cap default energy bids to $2,000 per megawatt hour. We do not oppose the second element of the proposal, but see risks with this and do not see the urgency of implementing an interim approach to increase the bid cap for storage resources by this summer. Beyond this, DMM does support the ISO promptly initiating a stakeholder process that would revise BCR rules for storage resources. And we recommend that the ISO begin development of an hourly default energy bid for resources with intraday opportunity cost that would appropriately identify how these costs may change hourly throughout the day, and specifically when costs may exceed $1,000 per megawatt hour and resources may submit bids exceeding $1,000 per megawatt hour. We also support making process improvements to updating the DEBs in real time to allow those to be updated more dynamically, especially under extreme events. So this concludes our comments. Thank you very much, and I would be happy to take any questions.
Okay, if we can go ahead and move to the Market Surveillance Committee now, but stay tuned in case we have questions when we get to that segment. We have Scott Harvey with the Market Surveillance Committee. Scott, are you available?
I'm online. I see myself. Thank
we see you and hear you. Thank you.
Board of Governors and governing body. I first apologize for the 40-page opinion but we felt that there are a lot of complicated issues here that touched on many different elements of the market, and we need to provide some context for some of the discussion and choices you need to make. We also felt that there were some technical misunderstandings on elements of the market design and software that deserve discussion. So I apologize, but we felt it was necessary. The context for this stakeholder process is the evolving resource mix in the Western market and the Western EIM, and the increase in energy limited resources as part of that mix, and the creating a situation which there's less margin for error in managing the use of those resources over the day. And I won't repeat what Becky and Adam have said. We see that there are examples of this being a problem over the past years, and we view this initiative as a needed but not the final step in evolving the Western EIM market to address these challenges. In the remainder of my comments, I'm going to focus on two issues that are particularly relevant. First, the application of these changes to the day-ahead market, and secondly, discussion of whether exceptional dispatch and other out-of-market actions are sufficient to maintain reliability this summer. The issues regarding the day-ahead market only really concern the California ISO balancing area, because the EDAM won't be in effect for a couple of years. So for much of the Western EIM, we have a few more years to think about how to evolve this design. As we explained in our comments, we feel that some of the discussion with stakeholders, that the key point, which Becky made as well, is that the IFM already takes account of opportunity costs over the day. It's part of the software. It's the optimization inherently addresses this problem. So it's not, the whole point of this proceeding is to deal with the problem in the real-time market in which the software does not internalize opportunity costs. The only way the market software can take account of opportunity costs in future hours is if they're reflected in the market participant offer prices. That's not true in the day-ahead market. The only reason to submit higher offer prices in the day-ahead market would be to withhold the supply of batteries from the day-ahead market, which we don't think is a good idea at this point in time. The day-ahead market schedules serve a function of incenting efficient behavior and are one factor that the operators use in managing the supply over the day. So we felt this is not necessary and potentially counterproductive, so we don't support the extension of the increase in the offer caps to the day-ahead market. The other topic we wanted to talk about a little bit more was the exceptional dispatch and other out-of-market mechanisms. And that they've been proposed that, we can rely on that for this summer. We see actually unintended consequences from continuing to rely and hope that we can get through the summer without these changes and rely just on unintended just on exceptional dispatch. We talked about that in our opinion, and we first noted that this exceptional dispatch doesn't even apply outside the California ISO balancing area. It can't be used for managing hydro energy limited resources or batteries in the Pacific Northwest or Rockies or any place else that there's a problem this summer. Some hypotheticals have been suggested that people should withhold their balancing area, should withhold supply from the Western EIM in order to manage this. That's fundamentally inconsistent in our view with the whole purpose of the Western EIM, with the diversity benefit, which reduces the amount of resources that we need to balance the market. And the whole point of having the Western EIM balancing market is to have these resources in the market so they can be used to balance intermittency when we need it. Even within the California ISO balancing area, we think that there's challenges in using exceptional dispatch to manage supply. We talked about some of the issues and the performance in past tight supply situations, and try to pull out how complicated it is for the operators to use exceptional dispatch on a whole 30, 40, 80 resources, basically taking them out of the dispatch entirely, raising their offer price to the $2,000 penalty price, and doing that just right so they don't create unintended power balance violations and on high prices when they're trying to manage state of charge. And we see some indications that this has been a problem in the past. So we see risks in relying on exceptional dispatch. Now, there are other problems. As Adam pointed out, we have issues with battery operators don't see it coming. We have an 1.5 to 2 hour delays in practice and being able to change their offer prices. So not everybody's gonna be able to raise their prices in just the right time to do that. So we're gonna need some exceptional dispatch, but we also need the ability of at least some of the storage operators to see it coming, to get their bids high enough up so that they don't get drained too soon. So we see that, relying on exceptional dispatch is not a solution. And this is at least raising the offer cap for those batteries, and those hydro resources can use it, is a part of the solution for this summer and for next winter. We're also not enthusiastic about targeted increases in the offer cap, because we think it's a myopic focus on all the batteries are going to go into the peak load hours with 4 hours of charge, which they won't. History shows they won't. And also this targeted increase ignores the fact that the Pacific Northwest and the Rockies may have a completely different period of the day, which is important for them. And we can't be California centric. We have to look at the design that works for the entire Western EIM. So we're not enthusiastic about the targeting. We don't think we should hold up these changes in order to target better. But we do agree with the DMM with the need for changes in the BCCR calculations and improvements to the way the maximum import bid calculation is done. So those are my initial comments, and if anybody has questions, I'll be glad to follow up and we'll get to that part of the discussion.
I have a question. Scott, this is Mary Leslie.
Hi, Mary. Yeah, and I was sorry, I was talking on mute, of course. And as I say, now's the time to get to questions, so your timing is perfect. So why don't we start with you?
Scott, do you agree that there is urgency? Do you see an urgency to this issue about the summer? I'm seeing conflicting messages regarding that. Would it be your preference to see this? Well, do you see the urgency of it? That's my question.
Well, we'll know better at the end of the summer what the summer turns out to be, but we do have a tight hydro situation in the Pacific Northwest, but not in California. And we generally, my perception is we have a tight resource mix across the West. But, maybe it's going to be a cool summer. Maybe they'll be sipping mint juleps in the control room, but I mean, it's a risk that, we don't know what's going to happen this summer, and having these bid caps in effect on 831 days is a risk, but it might not matter. And that's what makes this difficult. It's hard to know how things are going to play out. But if we get really tight supply later this summer, we're in 831 days, and situations where these things matter, we'll want to have these changes in effect. And as I said, they're not a solution. There are a lot of things. The West is in the front of the rest of the country. There are a lot of things we need to work on changing to use our resource mix more effectively. But this is a step.
Thank you. Any other questions, Mary, before I move on to the next hand?
No, that's very helpful. Thank you.
Great, thank you. John Prescott, you have your hand raised. Any questions for Dr. Harvey, Adam Swadley, or for Becky, or otherwise?
Yeah, thanks. This is probably for Becky. First of all, a big thank you to staff to put this together as quickly as you did. Is a high priority when I know you're flooded with what probably is high priority items all the way around. So thank you. I know there were extra hours put in on this, and that goes to the stakeholders as well. But my question really focuses on the proposed change slide, where you really outline the two different proposals, and we've heard a lot about them. And I just want to clarify in my mind what we're kind of talking about here temporally, and that is the first item, which is the removal of the cap on the default energy bids. That applies to all resources and both day ahead and real time. So that's kind of my first question. And the second one applies only to storage resources in real time and not day ahead. So, I need kind of confirmation on that. And then does that cause any sort of disparate treatment between resources? And then final, and I can re-ask this, and I'm asking 3 questions. The third one would be, since as Scott Harvey just pointed out, this really, the day ahead only applies to the California ISO since the EDAM isn't up and running. But if this is approved, would you anticipate any changes to the day ahead market would become part of the EDAM offering as well? So I hope that makes sense, Becky.
I think I got all those. Thank you for the questions. So good questions. So the first change to remove the $1,000 cap on default energy bids applies for all resources in both the day ahead and real-time markets. Yes, that is true. Now, remember that there is a limitation that I tried to highlight before with the storage default energy bid, that we're not able to use that as a bid cap because of the way the systems are currently configured. So, but I will say that in our internal conversations, to your second question about whether, well, maybe to an implied question of whether that limitation on the storage default energy bid, not being able to use that as a bid cap currently, whether that creates a disparity between resources, whether that's unduly discriminatory, for instance. In conversations that we've had, we think it's very important to emphasize that we're not saying that we're capping storage bids in the day ahead market at $1,000 a megawatt hour, right? Because it is the choice of the resource, what default energy bid calculation they would like to use. So a storage resource, if it would like to do so, could request a negotiated default energy bid, for instance. And then if that calculation were to go over $1,000, the storage resource is free to bid over $1,000 in the day ahead market according to that default energy bid. So that is the nuance, I think, for why there's been a bit of confusion about that part one applying to all resources in both the day ahead and real-time market. To your, maybe your second question on, which I think, and correct me, so you're pointing out or asking for confirmation, yes, the second part of the proposal applies just to storage resources and just in real time. So does that create a disparity between different resource types? I think that is something that we would, and I guess I hear the question a little bit as, how does that compare to what hydro resources are able to bid up to in real time? And if we think about those opportunity costs similarly or different, you know, are we kind of stacking up one resource to use before the other? And I think it could work out either way. I think this is an area that'll be important for us to monitor and to consider the market results that we see if we get into these conditions this summer or the next time we do get into these conditions, to really kind of think through whether any sort of whether there are any significant differences that we see in that in terms of that bidding flexibility, since it's coming from two different directions, and whether that's warranted and how we might want to kind of further consider that in the future. I think it's a fair question. And then the third part of your question, as for EDAM, I'm looking at my folks in the room. I think Anna might like to take that question.
Yeah, and I think the question was whether, in anticipation of the EDAM launch, whether we would make this as part of the offering, because at that point, yeah, and I think what we noted earlier, you know, the removal of the application of this in the day ahead for storage resources is done as a precautionary measure, but we will continue to look at going forward whether this has to evolve in general. And so it is possible that once it becomes, you know, perhaps after further scrutiny and consideration, if it is part of the day ahead offering, it will be part of the EDAM offering, if you wish, for all resources as well.
Okay, thank you.
Okay, thank you. I think next in the queue, we had Rebecca.
Thank you. Becky, this is for you. First and foremost, great job on your presentation. I know this is complicated, and the conversation today, including Adam and Scott, and your presentation is really, really helpful. And plus Dr. Pope yesterday to kind of crystallize the challenges and the opportunities we have here. First and foremost, well, second, I already said that. I'm really glad that the ISO was able to be receptive to stakeholders and move quickly. It's kind of a double-edged sword. Sometimes the ISO moves too slow or it moves too fast, and it's hard to hit that Goldilocks optimal approach. So I do really appreciate that the receptivity to stakeholders and coming up with what looks like the best solution that you could in the time frame for the summer. Also, I will be interested to follow, and I do appreciate that you're promising to take up the maximum import bid price calculation. What DMM has presented, I think really needs to be addressed. And I think, I mean, I know that was just beginning to be raised this year, but I look forward to finding out and learning more about how that goes and getting that corrected if it's however it plays out. And then to my actual question, I appreciate that the ISO is intending to monitor these actions over the summer, which, you know, obviously I know you guys monitor on a daily basis, but if things go off the rail or look strange or something doesn't appear right, how could what's the next step? I mean, how does the ISO go about addressing that? Do you stop using these options? Does it come back to the board? I mean, how do you fix it if it's going off the rails, I guess, is the simple question.
That's a good question. I appreciate you flagging, highlighting that. So I believe that, you know, assuming we move forward and FERC approves this, you know, these rules will be in our tariff and we have to comply with our tariff, absent, you know, until we file with FERC to change it or put them on notice or request otherwise. But I do think that, you know, because these are, these types of situations are days in which all eyes are on the ISO, right? In terms of, you know, having very high prices, very tight conditions potentially. I think that we would, as you mentioned, be monitoring on a regular basis and be prepared to react quickly if we needed to. I might ask if any of my colleagues at the table have anything else they'd like to offer on that. Just if there's anything else you'd like to offer other than we would aim to act quickly.
No, I think that's right. And this is Anna. I think it's always difficult to know ahead of time what those unanticipated, that's why they're unanticipated. But one of the things, you know, we've noted before, we would definitely will be monitoring day by day. And, you know, a lot of this monitoring relies also on data that comes out of the settlements, you know, the actual financial outcome. And those are things that we monitor on a regular basis, especially when we add new features to the market, as, you know, as Becky's noted. There's going to be steps we'll have to take if there are extreme unintended consequences that have to be acted swiftly. We always have the ability to, you know, file emergency basis at the commission. We also have the ability to, you know, roll back changes if you wish. That might take a few days or a little bit of time in order to do so. But those are always the things that we anticipate when we have new measures in place. And of course, because this one was done on a more expedited basis, we will be prepared to do that, to act as swiftly as possible.
Okay. Next on the queue we have is Rob Konzioka.
Thank you. I won't repeat all of John's and Rebecca's questions. I think they covered some of the territory I had thought about inquiring on. So I want to focus just on footnote number 1. And there was a lot of flurry of activity over the last 10 days or thereabouts. And I just want to make certain I understand what is included in footnote number 1. And I'm also suspecting there may be some public comments regarding that as well. And my understanding as I look at it is in that first sentence is it's telling me it's even if you wanted to, it's not available to include in the day ahead market. So that's question number one. Number two, if I understand what footnote number one is telling me, is that there are some workarounds. And then sentence three is telling me it's somewhat moot from the previous comments, and what's stated here is that from the comments that it really is not applicable generally, and there may be some isolated excursions on this issue. So is that generally correct? And I don't know, Becky, I should go to you, and I should go to Scott, if I should go to Adam, maybe all three.
Well, I can start, but no, I think that's a great capture of it. At bottom, we ended up adding part 2 to the proposal because we thought that the storage depth calculation, it was not sufficient to address the issue for storage resources, even if it could work as the bid cap. So we made the substantive policy decision, I'll say, to explore having a part 2 of the proposal to begin with, because we said, to your point, into the last sentence in the board, in the footnote, we don't see the values rising above $1,000 enough. Even on these, there's only a handful of these days. Even on those handful of days, we did not see those rising to the levels that we thought was needed, and for more than a couple of individual storage resources. And so I agree with your point. I think it's a bit of a moot point, right? Because we could do a lot of work to have that technology be in place. And we don't think that it would allow storage to bid over $1,000 in the day ahead market, ultimately.
Becky, thank you. And unless there's any other perspectives, no further questions.
Thank you, Rob. Severin, you've been patiently waiting, and you are next in the queue.
Yeah, I have a bunch of questions, and so if there isn't a quick answer, maybe we can take them offline. First of all, is the fourth highest hourly day ahead above $1,000 very often? It seems like that's a rare, extremely rare event.
Correct.
Yeah. Okay. So, in practice, that's not going to do much to change the real-time bid cap for storage.
Yes, the storage deb itself, right, does not do much. Right.
Okay.
Exactly.
But wait a minute, just to make clear, it won't change the default energy bid, but on the 831 days, the fourth highest price is high. So on most days, this is completely irrelevant.
No, I understand that. I'm asking about the 831 days. So
yeah, and on those days, this often, I think in the CAISO's presentation and in other presentations, they showed that on several of these days, it did hit $2,000, not just over $1,000, it hit the $2,000.
The fourth highest.
Right.
Fourth highest of the day ahead, or of the maximum import bid price, which?
Yeah, no, I'm asking about the maximum import bid price.
Thank you, Scott, for clarifying.
Sorry. Yeah, I'm sorry. Okay. I'll get back to that. So, I am still a little unclear on the highest cost verified bid, because bids are cost verified after the fact, right? Because they're formulaic, they're not numerical for a resource. They depend on the natural price of natural gas and I assume other issues, right?
So for the offer to be used to set price, it has to be cost verified before the market run. That was in the FERC Order 831. That's their condition. If we're not able to verify it before the market, they can get compensated after the fact through uplift, but it can't set market price unless it is cost verified.
And so we have a mechanism, I guess this is something I'm just not aware of, that is doing real-time natural gas pricing to real-time cost verification in sort of hours. So people know what their cost verification would be?
This is Anna. It kind of depends. There are an array of different types of default energy bids. Many of them are formulaic. And the ones that are formulaic, some of them, not all of them, and I want to say some because this is one of the limitations with a storage DEB, for example. Some of them have the opportunity to infiltrate. I say infiltrate because you can integrate within those formulas if there's, say, an increase in the fuel costs for a specific gas region, or if in the case of the hydro DEB, you see the price indices reflecting the opportunity cost for those resources. And FERC has, through, our filings and, commonly accepted, that in some cases, those formulas can have what we look at as a natural progression of the default energy bid through the formula. Not all of them are like that. The storage DEB has that limitation. It's a specific formulaic approach to looking at cost-based DEBs for storage, but it's dependent on the actual bids that are submitted in the day-ahead market for the case of the day-ahead DEB for storage. And you can't even, it's a chicken and the egg thing. You don't know those bids before the market runs. And so there is a limitation there with that one. The gas resources, they're all very formulaic based on, not all, but most are very formulaic based on the gas fuel price. And that gives you the opportunity to then use the natural progression of those DEBs as cost-based verified sources and the ability to bid above 1,000. Okay, great. A couple other quick questions. I just wanted to make sure I understand, actually in part one, water, the hydro resources, these are maximum flow, daily flow resource. That's the constraint that creates a time varying. I was a little surprised by this when I first, that there was time varying opportunity cost during the day for a hydro resource, but it's because they have a maximum flow. And so they're basically trying to figure out how to allocate a limited amount of water across different hours.
Yes, this is Mark Roth here. It's a maximum energy over the day.
Great. Okay, and then my last question, which is the most substantive, and I would like to invite comment from Scott and Adam and Becky. Are there either documented instances or credible simulations of battery storage resources exercising market power at current concentration levels of ownership? I mean, the whole point of bid mitigation is market power, and I'm just trying to get an idea of how worried should we be?
I may offer to let DMM go first on that one, or Scott, either way.
Yeah, just to make sure I got the questions, documented instances or credible simulations under current concentrations. You say,
and given what battery ownership looks like right now, I mean, can we put together a scenario where a firm does X, Y, and Z and is in a position where they would want to do something other than a price-taking behavior dispatch of their resource?
Yeah, I'll just say, I mean, outside of let's back up. There's the two angles of market power, right? There's
let me just add one thing, and I am asking about this summer because in some ways I'm asking, what could go wrong this summer? Yeah, sorry, go ahead.
Sure. So if we're talking about, local market power, I mean, we have the mitigation of local market power. You get, some relief there because the default energy bid is not changing. For the system market power, I think outside of, all but maybe the most extreme hours, right? The net load peak hours on the most extreme days. I don't think we see an indication that there would be great concern for exercise of system market power in those handful of hours. Based on the information that we have today, I don't think there's a strong indication, but you can't rule it out, right? And so that's something that I think we would we would monitor closely, specifically as submitted energy bids compare to default energy bids, and looking more generally at how the batteries operate over a day. But I think the short answer is that given the information we have now and current ownership and concentration of batteries, there are not strong indications of system market power concern from batteries.
Okay, thanks, Adam. Scott, did you have anything else to say on that subject, or if you don't, that's fine.
Just trying to unmute myself. Sorry, I'm handicapped that a bit. No, I tend to agree with Adam, although I don't have Adam's insight into the individual resource specific bids, but most of the batteries are small. I expect them to behave competitively, and on these hours, there are a lot of rents for them to earn. There may be specific instances of large batteries are owned by thermal generators that might have different incentives that may need to be addressed, but and that's why we have the local market power mitigation. I think more it's an issue that we need to focus on in the future, that we still have design that mitigates all the resources all the time when it's triggered. So if 3 big thermal generators have local market power, we mitigate all the shrimp, and the shrimp might be the batteries that we actually want to, have them retain their state of charge. So I think there's work to do here in the future, but not for this summer.
Yeah, I couldn't agree with you more. I think that we do need to keep revisiting this. I'll just say that I am not worried about disparity in the sense that these are different technologies. We have to treat them differently. We certainly, if we tried to treat them identically, we'd be treating them disparately relative to their capabilities. So I think it's clear that batteries are a whole different thing, and we're going to have to think through the different rules we need for them. Okay, I've spent enough time. Thank you.
Thank you, Severin. I don't see any other hands from the board or the governing body, but let me give you an opportunity before we move to public comment. Is there any other questions from the board or the governing body on this matter? Okay, seeing none. Silas, can we check for public comment? And it looks like there is one that I see from Don Trethaway, but go ahead and have people tee up.
If you would like to make a public comment, please press the raise hand icon on Zoom, or you can press #2 on the phone line if you would like to speak under public comment. Now, Don Trethaway, you have been sent a prompt to unmute yourself. You should be able to go ahead.
Good afternoon, Board of Governors and WEIM governing body. I'm Don Trethaway from GDS Associates, and I'm speaking on behalf of the California Energy Storage Alliance. So CESA does support management's proposal to remove the $1,000 cap on energy bids for all resources in the day-ahead and real-time market, and to allow storage resources additional bidding flexibility. Late last year, CESA discussed with CAISO staff our concerns with the implementation of FERC Order number 831 as it applied to the non-generator resource model, which was, in our mind, distorting the bid stack in the real-time market during high-priced conditions. And it's important to realize that the non-generator resource model is used by storage resources in a standalone, co-located, and hybrid configuration. As has been well documented today, storage resources are currently limited during high price conditions to bid at $1,000, when other resources who do not have intraday opportunity costs can actually bid higher. And this results in market inefficiencies and reliability concerns because storage can be discharged earlier in the day and is then unavailable at peak system needs. And with the increasing dependence on storage resources in the CAISO, and you could argue in the WEIM as well, we believe that it was urgent that the CAISO address this market design flaw prior to summer 2024. So while CESA supports management's proposal, there's 2 areas that we wanted to have a little more discussion on. The first is, and Becky did touch on this in her remarks, that it's not entirely accurate to say the removal of the $1,000 cap on default energy bids will apply to all resources in the day-ahead market. There's multiple different default energy bid options that can be selected. And if a storage resource selects the storage DEB, then that resource will not be able to have a cost above $1,000, even if the CAISO's default energy bid calculation calculates a cost above $1,000, or if, as part of market power mitigation, the system, the competitive LMP is above $1,000. And this is actually one of the impacts of not allowing the same bidding flexibility in day ahead and real time. I would note, though, that we do agree with Dr. Pope that this isn't an issue that would cause CISA to now oppose this proposal. And as Becky also highlighted in her comments, storage resources can change from the storage DEB to a negotiated DEB, which may provide them the opportunity to bid above 1,000 in the day ahead market. And I think the CAISO should be prepared potentially for a large number of resources seeking to change their methodology in order to take advantage of that fact. The second issue is, not all storage resources are going to be allowed additional bidding flexibility. As I mentioned earlier, CISA expressed its concerns with the implementation of FERC Order 831 in regard to the non-generator resource model, which applies to standalone, co-located, and hybrid storage configurations. The CAISO proposal does not allow non-generator resources in the hybrid configuration, the storage bidding flexibility. When we looked at the draft tariff language on May 13th, the bidding flexibility to non-generated resources was provided with no limitations. However, when the draft tariff language was posted on May 20th, which was to reflect the fact that we were no longer going to apply the bidding flexibility in the day-ahead timeframe, there was additional language added that highlighted that hybrid resources were not eligible for this bidding flexibility. And I would note that the posted board memo, as well as the posted presentation, did not explicitly highlight this issue. We went back and I was trying to figure out where this was actually discussed. And it's actually, I found it. It's in footnote number 7 of the draft final proposal, where it was highlighted that this would not be extended to hybrid resources. So CISA believes that the intent of the policy was to apply the bidding flexibility to all non-generator resources, regardless of what configuration the storage resource selected. CISA isn't aware of any implementation difficulties with allowing this bidding flexibility to be extended to hybrid resources, and would request the board and the governing body to direct the CAISO management to reconsider and allow hybrid resources the same bidding flexibility as other storage configurations. We look forward to working with CAISO and all stakeholders to develop a durable solution for the summer of 2025, as well as the planned Energy Storage Enhancements Initiative, which will improve the modeling of storage resources and address some of the issues highlighted in the MSC opinion. I'd be happy to answer any questions.
Silas, any other commenters on the line?
Scott Ranzel is in the queue as well.
Okay.
Scott,
Do we have a response to the questions that Don raised, though?
Oh yeah, absolutely. Sorry.
Thank you.
Did you want to respond, or did you looking for a management response?
I'm looking for management's response, yes.
Yeah, Anna or Becky?
Sure, I can start. And no, I appreciate the point, Don. Thanks for raising it. And I think this is not, we did not end up talking much about, or hardly any, about hybrid resources in particular in the stakeholder conversation. And I think a lot of that is because we started the conversation with default energy bids and sort of thinking about that being the vehicle through which we allow resource offers to go above $1,000 today, right? That is the only way that a resource can offer above $1,000 is if you get an adjustment to your DEB or through this reference level change request process. And as I mentioned earlier, hybrid resources do not have default energy bids, much like proxy demand response, which is a resource type that other stakeholders had brought up, that they thought also sort of merited consideration for having these kinds of intraday opportunity costs, right? Or having limited energy to offer over the course of the day. So, right, recognize that there has been some questions as to why doesn't this, or why shouldn't these provisions apply to hybrids? The default energy bid piece is one, part one of the proposal, for instance, could not apply to could not apply to hybrids because they don't have a default energy bid to uncap, right? But I mean, more generally, I think that hybrid resources, again, they operate as a single resource interfacing with the ISO market for whatever pieces they have. Solar storage, wind storage, we see it as a single resource. We do not model, for instance, the state of charge constraint associated with that resource, right? Because we have less visibility. We don't have visibility to the individual components of that resource because it's a sort of in electing to operate as a hybrid resource. They are electing, the resource owner is electing to manage sort of both parts of the resource themselves. And that's fine, but of course, but there's less visibility for us. We don't have that state of charge constraint. It would seem like if you, it seems like in order to apply the proposal to that type of resource, you would at least want to have more visibility into the storage piece of that unit in particular, right? And we don't have as much of that. And then again, more generally, sort of what that hybrid resource, how they interact with the market. We do think that they can shape their resource output over the course of the day in a different way than just sort of standalone storage. And ultimately, we're open to including hybrids in the conversation going forward and thinking about this type of problem through the lens of a hybrid resource. But for this summer, we didn't feel that we had an adequate amount of time to come up with sort of an opportunity cost characterization for hybrid resources. So I'll pause there and see if anyone has anything else to add.
Yeah, thanks, Becky. Really appreciate that. This is a step forward, as was said before, and it's a process. So look forward to continuing efforts in this, and let's address hybrid resources too, and make sure we optimize all available resources across the board, especially since we don't know what the summer is going to look like.
Jen, you have a question?
Yes, Roger, I just wanted to ask you if at the conclusion of the public comment, will you be inviting board members to make comments? So far, we've been just focused on questions, but we probably should allow comments before we actually vote.
Yeah, well, it was, if I wasn't clear, it was comments, questions, or anything. So comments are welcome at this point too. I can wait until it looks like at this point we have one more public comment. And then I'm happy to open it up for any comment from the board.
Yeah, I think we should finish up the public comments first. Thanks.
Absolutely. Okay.
Scott, you've been sent a prompt to unmute yourself. You can go ahead with your comment.
Hi, good afternoon to the Board of Governors and the WEIM governing body. I'm going to keep my comments brief, and I'm not going to repeat or reiterate anything that's already been said. I want to thank the CAISO for working swiftly on the issue. It has limitations, it has challenges, it has concerns that remain that have been expressed here today. We would really encourage the CAISO to think about in their implementation plan a market simulation that allows for market participants to participate as well, even if only for a limited time. and ensure that the monitoring and swift action that may be necessary, hopefully not, but it may be necessary, that has already been identified, is put into place. One final thought is, and Don alluded to this, many have alluded to this, there is a lot of consensus on the idea that this does not present a long-term solution. And I would strongly encourage us to start today and not wait. We really need to have in place and operational before the summer of 2025 a more durable solution to these challenges and some of the concerns that are raised. Let me stop there and say thank you and answer any questions if there are any.
Okay. Any questions or comments for Scott? Silas, anyone else in the queue?
No, there are no further comments in queue at this time.
All right, at this point, before we go to a vote, I've heard from both chairs, so let me start with you, Jan, if you have comments that you would like to make, and anyone else from the board, and then we'll go to the governing body and Andy.
Yes, thank you very much, Roger. I just wanted to first off thank everyone that's participated in this expedited process. We received lots of letters from stakeholders. The MSC report was excellent. We've had a lot of input from DMM, which has been very helpful in thinking through these issues. And of course, the staff presentation. Congratulations, Becky, you're surviving here in your new role. And we do appreciate all the hard work that's being evidenced through these presentations. It seems to me that we need to move forward today to fix this issue as best we can with the resources we have now and the facts that we have now, so that something is in place to help us this summer if we need it. We need every tool we can get. I am hearing loud and clear, though, from all the comments that we've received, that we simply have to do a lot more work on batteries and storage, and particularly fixing the BCR rules, but they are unique, they are different, and we need to probably come up with the set of rules that really works to match that resource and enable us to both have it be a long-term resource for the industry and for customers, but also to make sure it's deployed at the time that we need it, available to us to address the reliability issues that we may be confronting. And so I appreciate the comments also made by CISA, because I know they've been working hard on this as well. And it sounded like from what Becky said that the one comment that was made on hybrid projects, that will be a topic of future conversations. So with that, I just wanted to thank everyone for their participation and urge my colleagues that we go ahead and move forward with this today. Thanks.
Thank you, Jan. Before I turn to the governing body, let me just check if there's any other members of the board that have questions. I see there's some hands up for the governing body. Okay, just wanted to make sure I didn't skip over anyone. So Andy, let me turn to you. I think you may have had a comment, and then we'll can walk through the rest of the governing body.
Sure, actually I'll let the other members go first. Thanks.
Okay, I don't know who popped up first, so I'm just going to go in order here. Anita.
Thank you, Roger. So first of all, I want to acknowledge all the work by the staff. They pulled this out on an expedited basis, but I also have to give a little bit of props to the Regional Issues Forum. They did a panel on this in their March meeting that really highlighted the need for this action, and I thought it was well presented. It was what we hoped there would be, someone that's bringing issues forward. So they also provided a letter of, well, not consensus, just a letter of, hey, they're watching, they're paying attention. And there's a lot of support for this move, and there's also a lot of concern for this move. Recognizing that it's just going to go into real time, which I think is a good place to start in. And my caveat is that it's not a stopping point, that the initiative to move this into the day ahead, if not before 2025, maybe once we get through seeing it in real time, we can do something in the day ahead sooner than 2025. But I know the ISO is really swamped with a lot of initiatives, but I think there's enough interest in seeing it in the day ahead as well that it should not stop. And if we can get ahead of 2025, that would be great. Lastly, the monitoring and reporting, I think, is critical to making this modification. And there are enough caveats from the market participants and stakeholders who, even those that support making the change, that the transparency in the monitoring and reporting is imperative, and it's urgent that corrections get made expediently if there are unintended consequences. With that, this is something I'm going to support as we get to the voting. Thank you.
Thank you, Anita. Next in order, John.
Okay, thanks. I plan to support this proposal as we've heard today. And it's because I believe it really will improve market efficiency and reliability as proposed. And after hearing and reviewing and studying the comments and analysis of staff, stakeholders, our expert, MSC, DMM, RIF, and others, I'm really comfortable approving this, but it's not without risk. And I think, Anita just mentioned and others have mentioned, it's going to need continual monitoring by both staff and DMM to make sure it's okay. Also heard from Scott Renzel an offer for market participants to participate in testing. I would like the staff to consider that. But I really believe the benefits outweigh the risk. And I fully support continued work on a longer term and more comprehensive solution that would be looked at, I guess, through the price formation initiative. End of report.
Thank you, John. Rob? Your hand is
Thank
up.
you. I too appreciate the very robust process that got us to where we are today. And staff deserves a lot of credit for their diligence. And a big thank you also to all the stakeholders for moving this forward and shaping the proposal that we have before us today. And those efforts were significant and they are appreciated. As a sort of a quick overview, at the beginning of this initiative, there was a lot of strong, nearly unanimous support to move quickly and implement this summer. But the work identified by staff and by all the stakeholders identified the complexities and issues beyond those originally assumed. But ultimately, this is a sign of a good and solid and open process. All that said, in the previous remarks, which I endorse, I agree that the need and benefit for the proposed and limited action to be implemented this summer is greater than waiting for a more elegant and comprehensive solution at a later date. And as such, I also plan to support the proposal. I thought Scott Renzel made some very pertinent remarks, and that is ensuring that the checkout testing and market simulation is robust before going live. I think that will be very helpful in providing the type of assurance and support of the proposal as it moves forward. And then, as noted by just about everybody, that the commenters have noted the need for a more durable, long-term, comprehensive solution with a preference for summer 2025. And as if there's not enough on the CAISO plate already, consideration should be given and weighed for this as a priority. I do look forward to seeing a more elegant and comprehensive solution at some point in time. With that, I conclude my remarks. Thank you.
Thank you, Rob. Rebecca, you have your hand up.
Yeah, I'll be brief, which when people say that, they never are, but I will be.
It's the promise.
Lawyers do that a lot, Roger.
Right.
I intend to support this. I think that is the best solution that we have to utilize for this summer. And I think it's critically important that we explore all options to ensure market efficiency and reliability. We're all in this together, and I think that this is a great solution. And I'm particularly concerned generally about the use of exceptional dispatch. And I appreciate the comments from MSC on this topic. And I am happy that we're exploring options that don't put so much emphasis on that or the pressure on the operators. So I intend to support this and appreciate all the hard work of everybody involved in this.
Thank you, Rebecca, as promised, and I'll be brief and hand it over to Andy.
Thanks, Roger. So I see these changes as urgent given the difficult hydro conditions in the Pacific Northwest. The market will benefit if more hydro resources are fully in the market all the time, as much as they can be. There's urgency for batteries too. With so many batteries online this summer, I support relying more on the market to manage charge and discharge rather than market operator directives. And I'm comfortable that any cost risks for consumers are small and outweighed by the consumer benefits of using hydro and batteries more efficiently. So I'll be supporting this. Thanks.
Thank you, Andy. Thank you, everyone, for your comments. At this point, we will move to the vote. And I don't know if you have the motion on the slides, but regardless, I will read it. Move that the ISO Board of Governors and WEIM governing body approve the changes to the rules for bidding above the soft offer cap as described in the memorandum dated May 21, 2024. And move that the ISO Board of Governors and WEIM governing body authorize management to make all necessary and appropriate filings with the Federal Energy Regulatory Commission to implement the change proposed in this memorandum, including any filings that implement the overarching initiative policy, but contain discrete revisions to incorporate commission guidance in any initial ruling on the proposed tariff amendment. With that, can I have a motion, please?
So moved.
So moved.
Second. Oh,
okay, that's all right. Severin is second, and I think Anita was first.
No, I was Angelina.
No, I think I got you.
Anita
Oh,
beat
you did? Okay.
we have the tape on that. And so let's go with the vote. Vice Chair Bornstein, your vote, please.
Aye.
Chair Campbell.
Aye.
Member Decker.
Aye.
Governor Edo.
Aye.
Governor Galitova.
Aye.
Vice Chair Konzioka.
Aye.
Governor Leslie.
Aye.
Member Prescott.
Aye.
Chair Shorey.
Aye.
And Member Wagner.
Aye.
Thank you, governors and governing body members. The motion does pass. And nice job, everybody. Let's move on in the interest of time to agenda item number 5. We have the briefing on the Westwide Governance Pathways Initiative. And here to introduce the topic is our Vice President of External Affairs, Stacey Crowley.
Thank you, Roger. Good afternoon, Chair Shorey, Chair Campbell, governors and governing body members. I'm pleased to introduce Kathleen Stacks, who's the co-chair of the launch committee for the Westwide Governance Pathways Initiative, who along with 6 of her fellow launch committee members will be providing you with a brief update on their activities and next steps. She will introduce the members participating today, but I just wanted to note that the committee is made up of 25 members plus 9 very engaged alternates across a broad range of industry interests and have worked extremely hard since they formed back in October. As you know, while the ISO is the subject of many of their discussions, we have remained in a neutral position, providing technical assistance as needed as they explore these governance options for Westwide electricity markets. They're a hardworking group, and I just want to thank all of them for their time and efforts and their really collegial and professional interactions. So with that, I'll turn it over to Kathleen.
Thanks so much, Stacey, and thank you to the Board of Governors and the governing body for your time and interest. We are excited to update you and then sort of begin our next phase of engagement, which we'll talk about a little bit later. Next slide, please. So quick agenda for you. We'll run through introductions, provide a little bit of background. Unfortunately, most of the regulators who are participating in the Pathways Initiative are on the road, driving to the airport from Vail. They've been at the Western NARUC conference the last few days. And so I instead have a statement of their support that I'll share with you as well. We'll kind of talk through the pathway structure and then the proposal, including our 2 steps, and then talk about a little bit about the next steps, and then happy to take any questions. Next step, please. Next slide, please. So I am joined today by Spencer Gray from the Northwest Intermountain Power Producers Coalition, Lisa Hickey from the Interwest Energy Alliance, Mark Joseph representing Labor, Evelyn Call from Community Choice, the California Community Choice, Scott Ranzel from Pacific Gas and Electric, and David Rubin from NV Energy. So you can see we've got sort of a mix of folks from inside California and outside. Next slide, please. Next one too. So just to take you guys back a little bit, the Pathways Initiative really got kicked off back in July of 2023 when regulators from California, Washington, Oregon, New Mexico, and Arizona wrote a letter to the Western Interstate Energy Board and CREPC, which is an acronym I can never quite remember all the words for, but the leadership of those organizations, which is really the regulators and state energy offices in the West, proposing that we start to pull together this group to work on an alternative regionalization proposal that creates an independent body and builds upon the success of all of the CAISO market services that so many entities in the West have been participating on. We took that letter from those regulators and a group of volunteers created the launch committee. The launch committee has a handful of work groups, which Lisa is going to speak to. And we were able, by the end of the year in December, to put out a document which contained some initial options and evaluation criteria for stakeholder review and input. We received that feedback in January. We also submitted an application to the Department of Energy for some funding to cover some stakeholder work. We were actually unsuccessful in that particular application, but plan to reapply for some different aspects of this work that we have ahead of us in the coming months. Based on that feedback, we revised the options and sort of narrowed and put together a very robust straw proposal in April of this year. Gave stakeholders about a little less than a month to review and provide feedback, and we got a lot of really constructive comments on both the step one part of this proposal and the second step. And so we're moving ahead on this entire package. So we're very excited about that. Next slide, please. This is, I think you guys have this in your materials, so I won't read it, but I wanted to just sort of put up here, as Stacy referenced, we have a very diverse set of launch committee members from within California and outside California, really representing a lot of different perspectives. And it has thus far been a very, I think we've had very healthy negotiations and discussions and really been able to keep this group together and working towards the same goal. So I think that's a really significant part of the work that we're doing. Next slide, please. Again, there's a lot of words on this slide, so I won't read it all to you, but this really kind of covers the primary areas of work that the launch committee is working on, calling out a couple of things. We're working towards a goal that includes an independent governance structure that can serve the largest footprint possible, including California, that preserves and builds upon the existing CAISO market structures, minimizes the duplication and incurrence of additional costs, and ultimately enables this new entity to evolve into a full regional transmission organization and all the services associated with that structure. Next slide, please. Before I pass this over to Evie, I'll just read a quick statement from the regulators who again are sorry they couldn't join us today. I know Alice Reynolds, President Reynolds from the CPUC is actually at her son's graduation. So we tried everybody. It's a busy time of year. But the excerpt I'm going to read is based on the comments that this group of regulators filed in response to the straw proposal that we released in April. We are encouraged by the outstanding levels of participation the launch committee has attracted and are pleased with the process established by the launch committee to develop practical solutions. While we do not have representatives that formally sit on the launch committee as voting members, we've provided three delegates and 3 alternatives to engage and comment on launch committee activities and proposals. We are pleased with how our opinions, as well as those of other stakeholder sectors, are sought as the launch committee considers options and establishes its preferred proposals. The launch committee has developed a step 1 proposal released on April 10th, 2024, which we believe is an important step, while further consideration on founding an independent regional entity continues. We appreciate that forward progress is being made with the Step 1 proposal and recognize there is much work that remains on developing a Step 2 proposal. We are supportive of the process the Launch Committee has initiated to further develop and refine these options. We're pleased that the Launch Committee has demonstrated a commitment to build on the preferred independent governance pathways options, informed by the thoughtful consideration of stakeholder input received as part of this common opportunity. We believe that further developing these options will provide important momentum as the entity is formed. And so with that, I'm actually, before I pass it over to, I'm passing it over to Lisa to talk a little bit about the structure of the pathways. I did want to actually give Scott Miller from the Western Power Trading Forum a minute to weigh in if he's still on.
Yeah.
It's okay. And I'm giving Scott a chance because Scott is calling in from Ireland. And so has quite the time difference. So Scott, happy to let you chime in here.
Yes, thanks, Kathleen. I'm zooming in from the west coast of Ireland on holiday, but I did want to take this opportunity to and take this time away from my holiday to emphasize what an impressive effort this has been by the Launch Committee. When we first started this back in the fall, we weren't sure what we were getting into, and we didn't know if it was going to go anywhere. But I must say that the collegiality that was exhibited by all the colleagues that I have on the Launch Committee and the hard work that's been done by so many of the people that you'll hear from, it has been an incredibly edifying effort. And I think that as someone who's been pushing for it's for 25 years, I think we're really positioning the West to be in a great place very, very soon. And so I just wanted to add this hurrah for the efforts of my colleagues on the Launch Committee. And a shout out to Kathleen. She's been herding cats and doing a great job at it. And Pam Sporberg from PG&E. So thank you all. And thanks for indulging me. That's all I've got.
Thanks, Scott. And with that, the other thing I will flag too is we may end up having to lose Spencer. So we'll cover Spencer's portion for him, but just wanted to maybe Spencer, before you drop, if you wanted to chime in at all as well too.
Thanks, Kathleen. I've got a few more minutes here, so why doesn't Lisa go ahead and go, and I'll hold on for a little bit.
Okay, perfect. Thanks, Spencer. All right, Lisa, I'll pass it to you to talk a little bit about the structure of the Launch Committee and the work we've been doing.
Thank you all very much. I will be succinct. Lisa Torman-Hickey. I am Senior Regulatory Attorney for the Interwest Energy Alliance. We are a trade association working in the Intermountain region and southwestern states. I'm assuming you can still hear me even though my video's locked.
Yep.
Great. And we are a trade association of renewable energy developers. So I serve as co-chair of a priority administration working group along with Jim Shetler of Bank. And we helped from day one to try to organize the Launch Committee because we needed to take some action. We needed to decide how we were going to make decisions and then express those decisions to third parties. So we wanted to be able to sign contracts, to create a budget, to raise funds, to fulfill the needs of the Launch Committee, and to express to third parties who is authorized to speak for the Launch Committee. And we wanted to obtain nonprofit status under 501c3 so that contributions could be considered to be charitable and educational purposes, which coincide with the scope of the Launch Committee's mission. So we created a mission and charter, which was approved by the Launch Committee, which acts somewhat as our internal bylaws and describes how we will vote and take action. That is posted on the WEIM website, which you could peruse to see all of our documents, internal as well as our deliverables that we have published to the public. We also created a memorandum of understanding between launch committee members that have voting status. So we have two types. I turned off my video just because it was locked up anyway. We have two types of launch committee members. We have voting and non-voting members. Those that represent government agencies, either the state regulators, those representing state agencies or federal agencies, are non-voting members, but they provide an important integrated part of the launch committee activities as advisors and education about their own perspectives and about the background of the movement towards markets in each of their states. So it provides a diverse public interest perspective to our work. They did not sign the MOU, the memorandum, but they remain active members of the launch committee, participating in all of our meetings. Those that did sign the MOU then were able to contract with third parties. So we did so, for example, to obtain our legal opinions from Perkins Coie. We retained the services of Utilicast to provide project management. And we did obtain the services of Global Impact, which is a fiscal sponsor to provide the nonprofit status for our work right away. We did develop a budget, which was about $500,000 for phase one of our work. Phase one continues through the end of June. We will have a little money left over to launch us into phase two, but we will continue our fundraising through phase two and phase three, and we anticipate needing about $1 million more to take us through those phases. Let's see, what else is important here? We have tried to maintain diligent stakeholder and public outreach. We represent sectors on the launch committee, and so we channel information back and input from our sectors, those that we represent. We also have monthly stakeholder meetings, and our recent stakeholder meetings have had several hundred people in attendance. And at those stakeholder meetings, the public is able to provide input and ask questions. In November, we distributed our initial bullet points and about the formation of our straw proposal and gathered input. We used that input through the months of January, February, March to develop the straw proposal that was published on April 10th. And then we received hundreds of pages and over 30 sets of comments in response to that straw proposal. And we are now digesting that and used it to adjust step one. And we will continue that analysis to revise step two, and a revised version we anticipate distributing within a few weeks. So we continue to reach out to stakeholders on an ongoing basis and at these monthly meetings, and we'll continue to do that through phase two and phase three, I expect, which you'll hear about more going forward. So I think with that, I will turn it back over and happy to receive any questions. Thank you very much again for hearing us today.
Thanks, Lisa. With that, we're going to pass it over to Evelyn Cole to talk about the first step of our Pathways proposal. Next slide, please.
Did we lose Spencer, Kathleen?
No, not yet. He's bought himself a few more minutes.
Okay. All right. Thank you for including us in your discussion today. I'm Evelyn Call, General Counsel for the California Community Choice Association. Today, I'm going to discuss briefly the stepwise approach to the problem that the launch committee has adopted to transition to more independent governance and the first step in that process. And then Spencer will take you through the second, assuming I get through this quickly enough. In December of 23, the launch committee issued a paper that framed a range of options. We had them all labeled as numbers, I think 0 through 4, to increase governance independence of the market. And the idea then was to choose a single model to develop and implement. Comments we received in response to our proposal, though, led us to another approach, which is a more incremental approach. And so we recognized that moving forward with the whole enchilada all at once was going to be complex and time consuming. And in an effort to try to bring the benefits of a broader EDAM footprint more quickly, we decided to do this stepwise approach where we would take a small bite with step 1 and move on to more independence in step 2. And I'd like to start before I discuss our stepwise approach to remind you that the Pathways Initiative is currently focused only on energy markets. I suspect all of you are aware of that, but not everyone is. We're looking only at the WEIM and the EDAM markets. We're not contemplating evolving CAISO authority in any other roles or functions, at least not at this time. So within that frame, we contemplate 3 steps. The first step is increasing the governing body's authority over existing energy markets within the CAISO envelope and within the scope of existing California law, and that's been very important to us. Step 2 goes further. It moves outside the CAISO envelope and creates a new regional organization to assume some form of governance of the real-time and day-ahead energy markets, and eventually to evolve to provide other market services. And then step 3, as you see here in a different color, would take this transition further. We would continue to expand the scope of regionalized functions and services that the RO would offer, potentially toward a regional transmission organization. And while step 3 isn't technically within this launch committee's scope, we've given it a good deal of thought, and especially Spencer has given it a good deal of thought. And the reason is we want to make sure that what we do in step 2 doesn't preclude us from making a move to a more mature step 3. So we're trying to think forward as we work through the step 2 solution. So I'm going to dive more deeply into step 1. So next page. The step 1 design increases independence and authority of the governing body over the existing markets. And as I said, without the formation of a new regional organization and without a change in California law. So it's a baby step toward independence, but a very important one, as you'll hear from David Rubin. And what it aims to do is invite broader participation in EDAM quickly and to get the benefits of EDAM to all customers as quickly as we can while we continue to work on step 2. And step 1 gets to this point and achieves the objectives basically by modifying the decision-making process for market tariffs. And the overarching idea is to shift the governing body authority from its current joint authority with the CAISO Board of Governors to primary authority. And I'm not going to walk you through this entire flow here, but I'll simply highlight where the step 1 governance process differs from the existing rules. And it differs primarily in 3 respects. First, everything that is currently within the scope of joint authority of the Board of Governors and the governing body becomes primary authority for the governing body. In order to determine what falls into that scope, we'll use the same test that we use today for joint authority, which is the applies to test. And it will be used to designate the areas of primary authority. And in that respect, there's no increase in the scope of decision-making that will be included in the primary authority compared to today's joint authority. So there's no broadening of the scope of the governing body's decision-making. Second, while today both the Board of Governors and the governing board vote to approve proposals, under step 1, and you see that in the first green circle there, the first vote will go to the WEIM governing body. The CAISO Board of Governors will consider it after it's been approved by the governing body. And third, and this is the most critical part of step one, is a change to the procedures that are used in the event the Board of Governors does not approve the initiative advanced by the governing body. So like today, if there were a disagreement between the Board of Governors and the governing body, the issue would go into a dispute resolution procedure, and that is described today under Section 2.2.2 of the WEIM Charter. If, however, the bodies can't agree and resolve their dispute, and I understand this has not happened to date, but the CAISO will have to use its Section 205 filing rights to submit both proposals, the Board of Governor proposal and the governing body proposal, to FERC on a co-equal basis, referred to as a dual filing or a jump ball filing, as it's used in the ISO New England today. So that's the most important step here, is essentially making FERC the final arbiter in the event of a disagreement between the Board of Governors and the governing body. The only circumstances in which the CAISO can break this circuit and unilaterally make a filing is if it's facing time-critical exigent circumstances that involve reliability or market integrity. There is one more step that's added that kind of counterbalances this unilateral right as well. Today, the CAISO would be required to submit a WEIM statement with its filing if the governing body so chose. But under step one, it goes a little bit further. If FERC makes a decision and the tariff is modified, the governing body can take that issue and drop it back into the dispute resolution process to develop a more durable solution for the future. So in addition to modifying the decision-making process, there's another important element that's been developed by a group of regulators who are working within Pathways. And that is that step one would augment the governing body's responsibility to the public interest. The regulators have developed proposed modifications to the WEIM Charter, and essentially they make sure that the governing body is bound to respect state and local authority to set procurement, environmental, reliability, and other public interest policies, and ultimately a responsibility to the consumers. So the last aspect I'll discuss here is the trigger. When would step one be implemented? And we would implement step one when a certain amount of load is committed through executed implementation agreements for EDAM to the EDAM market. And it would require that a set of geographically diverse, non-CAISO WEIM entities that have load that equals or is greater than 70% of the CAISO BA annual load for 2022 is the year that we're using, have executed those agreements. So there's a specific trigger that says when we hit that spot, then we'll go forward with implementation of the step one governance provisions. And so essentially the way it works out practically, if you were to take all of the entities that have committed today through some form of announcement and add NV Energy to that mix, it would trigger step one implementation. So on that note, I'll hand it off to Dave Rubin of NV Energy to discuss the importance of this step to him.
Thanks, Evie. And from our perspective, step one is important. I'm going to turn on the camera for a little bit. Step one is important in at least three significant ways. First, as to the specifics of the proposal, and maybe in the words of the Eagles, step one allows us to take it to the limit of what can be done under existing California law, placing the primary responsibility for the market oversight on the EIM governing body. And we certainly appreciate the legal analysis that was undertaken for the launch committee, and step one was clearly informed by those findings. Second, step one is important for the extremely broad coalition of stakeholders, not only those who participated in the launch committee, as you've seen, but also for those who've evidenced support for the proposal. For NV Energy, this inspires confidence not only for moving to a form of sole independent authority at some point over the EDAM and the EIM in step 2, but also for the continued engagement of the parties as we expand market services for the benefit of our customers. And third, the engagement and encouragement from the California ISO staff and management, from the EIM governing body members, and critically from the Cal ISO board for step 1 specifically, and pathways in general, we believe demonstrate a common understanding of the importance of independent market governance. It's certainly one thing to discuss that as a goal, but it's far more meaningful to take concrete actions to further that objective. And accordingly, for NV Energy, we've strongly supported the work of the launch committee, and it clearly helps inform our market evaluation. Let me pause there, Evie, and I'll turn it back to you.
You're on mute, Evie.
Should we go to review of comments, or did you want to grab Spencer before he leaves?
Let's go to Spencer and talk about step 2, and then we can come back and talk about comments as we look at next steps.
Thanks, Kathleen, and thanks for helping accommodate conflicting obligations here. Thanks as well to the board and to the governing body for having us have the chance to share some of our collective work over the last 8 months here in this meeting. I'm Spencer Gray. I'm the executive director of NIPSI, the IPP trade association in the Pacific Northwest. Evie and I have co-chaired the work on pulling together the content of the straw proposal here. So I'll cover step 2 at a sort of high level. We have a large number of open issues that the straw proposal that these graphics are drawn from spell out in a lot more detail. Step 2 is necessarily more complicated, and we need to fill in those details to finalize a revised proposal that's under consideration right now. We got as far as we could under the deadlines we'd set for ourselves to share some structural options and narrow those down from where we started in December. And that's really let us land the step 2 option that Evie's walked through. So I'll cover what the next step 2 structural options are that are under consideration now. So step 2 would be a proposal to have a durable long-term approach that encompasses what the launch committee's viewed as really the threshold test for independence. Does a separate body, a regional organization is what we've dubbed it, have the sole rights to determine the content of filings at FERC under Section 205 of the Federal Power Act? The risk analysis that Perkins Coie conducted for the launch committee really fleshed out the high risk of pursuing this option in the absence of a legislative change in California. So I think it's worth thinking about the full-fledged form of step 2 as contingent on a legislative enabling act. The launch committee is not drafting legislation. We're not involved as a committee in that work. That's the prerogative of the legislature. But we are involved in trying to figure out what potential legislation would aim for a structure in step 2. And we've really landed on 2 viable options in our view. This slide shows one of those 2 options. We've dubbed them option 2.0 and 2.5. That's the nomenclature that appeared in the December framework paper. So we may move away from that since we're having a proliferation of numbers and options and phases, but that's what's currently in the graphics and what you see on the screen there. The difference between the 2 options here for step 2, there is not a difference in the regional organization having sole authority over the content of Section 205 filings. In both cases, the rights of the regional organization board would remain in the same integrated tariff as the other services that the CAISO offers and the CAISO board oversees. The difference is really in the degree of institutional independence of the regional organization. We've explored the idea of having two different organizations or more than that have sole 205 rights within the same tariff. And with the help of Perkins Coie, we've concluded that it is a well-established precedent in other RTOs and ISOs, particularly around transmission owners and transmission revenue requirements. But also it effectively exists for a number of state committees and stakeholder committees elsewhere. So from a legal perspective, that's the feedback we've gotten about the viability of this under the Federal Power Act. Under this option 2.0, the relationship between the regional organization board and the CAISO board is in the form of an interface agreement. I think that term really captures what we've sketched out and have in mind. The RO's authority is really decision-making authority, and it encapsulates a form of governance independence, which does, I think, meet the threshold of what we were tasked by the regulators last summer to achieve. On the other hand, option 2.5, which is the next slide here, I'm not going to go line by line through the different boxes. The difference here is it's a contract for services agreement between the RO and the CAISO. And there's a conceptual difference here in that the CAISO turns into a form of a vendor under contract to the regional organization under that contract. And the RO becomes the outward-facing entity that's offering market services to the West. And as Evie mentioned, we've really focused on the energy markets here. You could imagine extending some of this to services beyond energy markets, but that's not a deep analysis that we've done. This conceptual leap involves some complicating factors, though, from option 2 to 2.5. There's 3 that we've identified as the highest profile complicating factors. What happens to the existing contracts that the CAISO has with counterparties who participate in the markets? Who remains or becomes the counterparty to them? Number 2, what is the appropriate staffing structure for the regional organization if it is to become the outward-facing entity offering energy market services? There's a question about an appropriate chain of command for staff, as well as a desire to avoid duplicative costs. And then number 3, what is the financial liability that the regional organization would need to carry? With added institutional authority comes added responsibility and liability. That includes things like being auditable, potentially holding reserves in the event of defaults. And so I think the main point here is there is a cost attached, an actual financial cost attached to institutional independence. And over the coming weeks and months, the launch committee plans to delve into that more and try to uncover what the real costs are of option 2.5 versus 2.0. I think the last point I wanted to underscore is that we did receive some consistent feedback from stakeholders. We got about 31 different comments back after our straw proposals release, with a desire for a deeper dive by the launch committee into what's sometimes dubbed small g governance, the stakeholder process of the regional organization as compared to what the process is at the CAISO today. And this is a distinguishable issue from the makeup of the governing board, from the nature of the Section 205 rights. So I just want to note that we've heard that feedback, and that's an added element in addition to the structural issues that I just very briefly outlined here. There are a lot more details included in the straw proposal, but the remainder of our work on step 2 is to wrestle with these trade-offs that I just described between these two models. Thanks, Catherine.
Yeah, absolutely. Thanks again. I think with that, we're going to shift over to Mark Joseph. We'll go to the next slide. Mark's going to talk a little bit more in depth about the public interest piece that Evie mentioned, but we wanted to also share with you the full list of evaluation criteria that the launch committee is using, that has been vetted with stakeholders as we go through this analysis and we're weighing these options that Spencer and Evie just described. So Mark.
Thank you and good afternoon, everyone. My name is Mark Joseph. I am the labor representative on the launch committee. I represent the IBEW in California. Under existing law, the CAISO is required to conduct its operations consistent with state and federal law and the interests of the people of California. These public interests include using available resources efficiently, reducing costs, and protecting public health and the environment. As step one transitions more authority away from the governing board into the WEIM governing body, it will be important to embed those same public interest obligations in the WEIM charter. We have to be sure both that consumers of all of the participating utilities see real economic benefits, and that the public interests of each of the states whose utilities are participating have their public interests protected. So as California's ability to protect its public interests through the governing board operating under California law decreases, we have to be sure that California and the other states' ability to protect their public interests is enhanced. We will propose to do that with changes to the WEIM charter that the regulators have prepared, so that protecting those public interests is part of the charter of the WEIM governing body. And you will see that proposal when we submit the package to you. Step two is a much bigger deal because it moves control of the rules of the markets out from under the CAISO umbrella to the new regional organization. This will require that California law be amended. Current law requires CAISO to manage the markets. That will have to be changed to allow the new RO to manage the markets. Now, I am often asked, given the 3-time failure of regionalization legislation, can California ever pass regionalization legislation? Well, my answer is the Pathways Initiative is not regionalization as that term has been used in the past. Previously, regionalization meant transforming the CAISO into an RTO for the West by removing California's power to appoint and confirm members of the governing board and replacing it with independent board members. Pathways is not that regionalization. Pathways would only change the governance of the EIM and EDAM markets. Those markets are now controlled, as you know, by the governing body, which operates under power delegated by the CAISO. Pathways would not change the governance of the CAISO at all, or the CAISO balancing authority, which is the key for the RPS bucket requirements, or transmission planning, or controller operation, or RA, or other reliability functions. Other than control of the rules of the energy markets, CAISO retains all the other roles with no change. And while a new entity would set the market rules under FERC authority as currently, CAISO would still operate the market. So each state would continue to set their own procurement, environmental reliability, and other public interest policies. And you see that as one of our important criteria for designing step two. Because the Pathways Initiative Step 2 is not regionalization, as we have used that term in the past, and it is instead a much more limited change, and because there will be clear economic benefits for customers of public and privately owned utilities, and because California will be able to preserve its ability to set its own public interest policies, and because at least most of the key opponents in the past will now be supporters, at least I am cautiously optimistic that the California legislature will want to pass legislation to enable this limited change to occur. Now, of course, I can't speak for any legislators, but we have been talking with key legislative staff to keep them up to date with the development of the Pathways proposals. And we anticipate proposing legislation for next year's, the 2025 legislative session. And with that, I will turn it back to
I'll take it.
Kathleen.
Thanks, Mark. And then I think we're moving things around a little bit. Evie, we'll come back to you to talk briefly about the comments that we received, particularly on step one, since that's our set of next steps, and then we'll go to Scott to really kind of lay out what we see ahead of us.
So with respect to step one comments, since it is closer to becoming final, we didn't really receive any objection, which is the good news here. There wasn't anyone that said, no, you shouldn't do step one, or you should make dramatic changes to it. So that was a really good to know. The only substantive change really that we found in the comments was a proposal that we create a reverse trigger. We have a trigger for implementation of step one. And the question was, if load in EDAM falls below the step one implementation trigger, shouldn't we have the right to reconsider the step one change? In other words, go back to the original governance. And currently the board, the CAISO bylaws have a similar provision in there for the WEIM. And so we've been talking about whether there's something we could model along those lines to provide for a reverse trigger. Otherwise, the things that folks sought clarification on were, what does exigent circumstance mean? Because we are saying that the CAISO retains its unilateral right to file a tariff under those circumstances, under time-critical exigent circumstances. So what we've done is to explain that that's the current language that's used in the WEIM charter, so there's nothing changing there. We did a little research into other areas to see how the term was used, and the only kinds of definitions we found were pretty much what we have in the charter already. So there wasn't any new light shed on it. So essentially, I think exigent circumstances, and particularly time critical, you know it when you see it, is the answer to that for those who are curious about it. They also ask us to do a little more in-depth explanation of the Bowser rule and spelling out the process. To go deeper in explaining how the jump ball worked and talk about cases in which FERC has interpreted jump ball provisions in the past. And to talk a little bit more about how the applies to test works today, and therefore we'll be working under step one. And to go a little deeper into the dispute resolution process in section 2.2.2 of the charter. So other than that, there were no significant comments on step one. We are in the process now of revising the proposal that will go out, I believe, next week. And it will be voted on May 31st. So I think we are in good shape on step one and moving that over to the CAISO stakeholder process.
Thanks, Evie. And with that, let's pass it over to Scott Renzel to talk a little bit about the next steps with step one and sort of the next phases that we have through the launch committee. And you can go to the next slide, please.
Great, thanks for the opportunity. So I think we've talked about a lot of these steps, but let me run through how we turn the ideas and the concepts that are being talked about into action. As you can see here on May 31st, the launch committee is going to hold a public stakeholder meeting that we have been doing regularly for a month. We expect to have a public vote on the step one proposal. Our expectation after that is we will quickly turn around that document and deliver a letter to the CAISO Board of Governors and the WEIM governing body, outlining the process that we've gone through, and ask for them to initiate a stakeholder process inside the CAISO to move that idea forward. In parallel, we'll be working on refining, gaining more transparency and exposure to the stakeholder community on step two. There's complications that have already been talked about here today on step two and how to answer those questions, how to seek stakeholder feedback. So we are going to be holding a couple of workshops and collaborating all along with CAISO staff as we kind of define and embed those into what will be a more robust step two proposal. Our expectation at this point in time is that comes out in the late fall, start of Q4, where we would again go back to a public meeting and vote on what that step two proposal looks like and how we would move that forward. As we get through that, it also starts to initiate the idea of developing that RO, identifying board members, setting up a structure for that. That will start to happen in the very late 24, early 25 timeframe. And that will also go in parallel with legislative activity that has been talked about. And our expectation is there'll be an idea of legislative language, hopefully in the 2025 legislative session, that would allow for and enable the move towards a step 2 recommendation that would come from the launch committee. And with that, let me turn it back to Kathleen. I think we're going to kick it open for questions, but certainly want to say thank you to all for the engagement and participation.
Thanks, Scott. And again, thank you all for your time. We are happy to take questions about any one of these things.
Thank you, Kathleen. Let me turn it to the board and the governing body for any comments, questions, or otherwise.
I see Jan's hand up and then Rebecca's.
Okay. Jan?
Yes, thank you. And thank you so much for this presentation. This was excellent and is a really good overview, giving us all a sense of what all you've accomplished and, and the work that still remains to be done. At any rate, I thought that I would take this opportunity, and maybe I can ask Andy to follow on after me, in outlining the next steps chart that you have up here. We've had a little bit of a chance to talk about how we will handle this in order to get the stakeholder comment process going. So if the committee will, the launch committee will send the letter to Andy and I as the chairs of the respective boards, we would then go ahead at this point, assuming we get that we would acknowledge receipt, acknowledge that the proposal is formally been provided to us, and then direct the staff to commence the public stakeholder process. We would anticipate doing most of the things we usually do in public stakeholder processes, with calls and a comment period that would be provided. I did want to emphasize that number one, we're very hopeful that the launch committee will help us through this process by being available as we go through it to answer questions or assist us, because it will be your proposal. So I want to make sure we're not the ones trying to explain it. We want to be sure we're understanding it correctly ourselves. And so I wanted to mention that. And then as we do get comments, when the comments do close on the stakeholder process, it would be our expectation then that we would give the launch committee a formal opportunity to respond to any comments that we might be receiving. I'm hopeful that we're going to get a lot of very supportive comments, but we may also get some that require some thought and perhaps even some opportunity to respond. So we would be looking in a formal way to have you provide us with any information you want to based on the comments that come through that process. I do want to encourage everyone that's listening to the call, all of our stakeholders, to participate and comment and let us know what you think we should be thinking about as we consider this proposal. I think that one of the things we'll probably try and figure out too going into this is what sort of engagement we should do with the RIF, with the Bosser forums. There are some opportunities with existing stakeholder groups that are out there, and we would try and make sure that we give them an opportunity. I think that in terms of the complicated stuff about how to do tariff changes and that sort of thing, we'll do that after. That will come later. We're just trying to get through this initial process of getting people's comments to figure out if we can what we should be considering before we actually vote on this proposal. So if you don't mind, Roger, I'll go ahead and ask Andy if he wanted to add anything to what I just said.
Thanks, Chair Shorey. Yeah, that sounds, I concur with that. I think it's certainly our intention to move expeditiously. Appreciate all the tremendous work Pathways has done, including very public-oriented process. We know also will provide ample opportunity for further stakeholder process. I think, yeah, timing-wise, we've of course looked forward to our meeting calendar. Also, there's kind of a gap between our July meeting and our September meeting, so it's very possible. If we'll see how things fall together, but we'd have some sort of special meeting between those dates if necessary, if inappropriate. But
yes,
thank you.
We might end up with something in August.
Mm-hmm.
We'll try and move expeditiously, I guess is what we're trying to say.
Well, we are happy to work with you and collaborate on all of the comments and however we can be helpful. We are at your service.
Great. Thank you very much.
Yeah, thank you.
Thank you. Thank you, Jan. Rebecca, you have your hand up?
Yes, thank you. great presentation. Thanks for folding us in on this. You've all been doing a lot of really hard work. I'm familiar with the challenges that you've been facing, and it's good to see some new fresh faces of stakeholders who weren't previously engaged. So that's awesome, and I'm very excited to see that and optimistic about the future. Look forward to step 1. I do have a quick question on step 2. And step 2, as it is envisioned now, is it limited to 2 or 2.5, or is there room to maneuver? I'm not necessarily saying a new option or variations on that as you work through this process. All I see is 2 and 2.5, so just wondering if there's any room for other ideas there.
Abby, did you want to take that, or you want me to?
Sure, I'm happy to. Yes, there is room. We talked about that at our meeting in Portland last week about whether there were any other types of structures we should consider. And I think we remain open to other ideas that are compatible with the goals we're trying to achieve. No one has raised anything yet, though, that has risen high enough in our discussions to require exploration. That doesn't mean they won't, but I think, you know, it'll be a process of discovering as we go through, fleshing out 2 and 2.5, whether there are things we're not thinking about or things that could be improved upon that might take us outside of that scope.
I don't see any more hands raised by the governing body or the board, but I'll give you one last opportunity. And if you have anything, or further opportunities if you decide you do after public comment. And Silas, at this point, can we seek any public comment?
If you would like to make a public comment, please press the raise hand icon on Zoom, or if you're on the phone line, you can press #2 on your phone to enter the comment queue. There are no comments from attendees on Zoom or the phones at this time.
Thank you, Silas. Well, at this point, I think we can move to our
Roger,
next.
I see Anita's hand up. Sorry to interrupt.
Oh, I'm sorry. I don't see
okay.
it for some reason. Yeah, Anita?
You guys have done a lot of work, and you've done a lot of work in a really compressed time frame. And you may not be getting a lot of diffusion from us at this point, but we are excited to get this from you. And I just want to acknowledge the work that's gone on, the conversations you guys have had, the outreaches that has gone on across the board, and really look forward to seeing more come forward into step 2. So I just want to say thanks. And it is an exciting time.
Thank you. And if I might just respond to that real fast too, I want to, on behalf of the launch committee, thank the CAISO team for being so collaborative and so constructive. They have been responsive to lots of questions and all kinds of conversations, and have put in a significant amount of time as well. So we're really appreciative of the partnership so far, and all of the input they have provided to help the launch committee really figure out how to get this done. So thank you, and thanks to the whole CAISO team as well.
Thank you, Kathleen. And I will
appreciate your support. It's been amazing to work with.
All right. Well, now at this point, unless someone's seeing one I see no more hands, and we can move to the next agenda item, which is our update on the extended day ahead market onboarding and implementation. And to start out the presentation is our Vice President of Power Systems and Market Technology, Khaled Abdulrahman. Khaled?
Yes, good afternoon, Chair Chori and Chair Campbell, ISO Board of Governors, and the WEIM governing body members. The ISO management team is is going to provide an update on the extended day-ahead market implementation. And we are teaming up with Pacific Corp. Kristen Rock is going to also provide the update from Pacific Corp side. So next page, please. I'll try to go through this as fast as I can. But I would say the key accomplishment, the first thing I would like to point out is the signing of the implementation agreement with Pacific Corp. So this was signed on April 24. So this is a major milestone that allows the California ISO project team to start formally, formalizing the schedule and the different tasks and project team tasks in order to accomplish a successful go live date. So another maybe major accomplishment is, which is the first time that we are doing something like this. It is a vendor kind of forum that the ISO put together in order to go and discuss a deep dive into the technical design of the EDAM. This was our attempt to try to expedite the answering the questions of the vendors in order to allow the EDAM entities to enable them to enter into a commercial statement of work with their vendors in order to lock the different implementation dates for them. This was received with a very positive feedback we received from the vendors, and it is something that we would like to probably continue to do since, as I said, it was very successful and it is reducing quite a bit of the, the back and forth type of questions. Next page, please. Also, I would like to point out that we do have now a dedicated place under the WEIM page. There is a tab that is called EDAM, where we are putting there all the information related to the EDAM, whether it is the onboarding, information related to how you join the EDAM and the onboarding process, or information related to the state of the market and the EDAM policies. So that is under the, if you go to the WEIM page, there is a tab at the top that all the EDAM information is there. We are trying also to add more training material into the EDAM related to the entity training or any role-based training plan we are as we are developing it. Also, we're trying to convert some information into like videos and computer-based training. Next page, please. Just a quick, the key accomplishment since the last time we gave this update. As I said, probably at the top of this is the execution of the Pacific Corp implementation agreement, but also we also filed the EDAM access charge tariff that we are hoping that we can receive the FERC approval for this filing. And also we have published all of the the technical specification, the business requirements for both the EDAM and the day-ahead market enhancement, because the EDAM that we are building is going to be built on top of the day-ahead market enhancement. So all of the day-ahead market enhancement technical specification has been posted. The EDAM technical specification, which allows the different entities and their vendors to start building the systems and the interfaces to interface with the EDAM platform. A lot of those technical specifications are also posted for the EDAM, including the settlement specification. We started to also work on the kind of a joint integration schedule between us and Pacific Corp. This is still work on progress in order to create all of the dependencies between our two schedules. So this is on track, and we are happy that things are actually moving very positively in that direction. What is to come? We are, as I said, we are expecting to receive the FERC approval. This will give us more certainty on the implementation schedule, as well as we are also working with bank on maybe setting up some timing for what is appropriate for them to join, and also what would be an appropriate time for them to for the implementation agreement. Next, please. Okay, so this is a quick kind of overview of where we are. We are in the second half of, let's say, 2024. So all of the previous milestones have been accomplished on schedule. We are now, right now in the period from now till end of 2024. We are in the period where we are working with our software vendors and started receiving certain code drops. And we will start the testing process, of course, that will last all the way till of the June of 2025, where we will initiate the integration testing with the EDAM entities that are planning to go for the go live date. After that, in September of 2025 is our market sim, and then January of 2026, our parallel operation starts, and we will be going live in May 2026. With this, I'd like actually to introduce Kristen Rock, the Director of Market Policy and Analytics, and also the EDAM Implementation Director at Pacific Corp, for give us also a quick update on what's happening at Pacific Corp. Kristen?
Thank you, and thank you for the invitation to come back to you and give you an implementation update. And if I may have the slides advanced. I will have 2 short slides. I will not repeat anything that Khaled has already outlined and instead build on that. Next slide, please. And so from Pacific Corp's perspective, in addition to all the accomplishments and the work that Khaled has already outlined, I think some of our key focus areas since we last spoke was really that we've launched our OAT process in April. In fact, we're going to be publishing our draft OAT on June 4th, and we'll then have immediately following that on the 6th, a public meeting to discuss and get feedback from stakeholders. There will be comment period. So we are very busy on the OAT development process and are seeking to collaborate and engage with a lot of the other entities, recognizing the importance of this process. Another key accomplishment for us, and particularly not technical, but facilitating nonetheless, is the procurement process. And as Khaled mentioned, we were very grateful for CAISO's willingness and very creative ways of standing up the vendor workshops that were hosted at the CAISO, and just how fundamental they were to allow the vendors to provide us with budgets and information that we needed to move forward. We're currently in the process now of really honing in on detailed scopes of work with all of our vendors. We have, I don't know, less than about 10 major vendors that we're working with that we're all working on in parallel. So we're hoping to move to contracting very soon and in the middle of summer, with a few days left before June 1 of 2024. Khaled mentioned by June of next year, we need to be ready to begin testing, and that is a large amount of work for us to get done. The vendors are generally indicating that they're ready and confident they can do that. Having said all of that, there's still a lot to be figured out, and it has been appreciated. And I think we're all the larger team, not just the Pacific Corp team, but the CAISO team and the Pacific Corp team, as well as our extended vendor teams. I think we have all arrived at the fact that this may not be, as the first one, may not be as elegant and as ideal as maybe others may want and have all the information always available. But at this point, I'm happy to report that I think everybody is marching in the same direction. And with the philosophy of, if it had to be done, how would we do it? And how do we create a process and kind of a mold for others to step into and working with in a way that is collaborative and that will be a good onboarding for us, as well as others coming after us, and really provide a good example for EDAM and the benefits that can be received from EDAM participation. So internal readiness, we have a lot. I mentioned this in my last update. We have issued some RFPs. We are going to be really looking at new technologies and vendors while we are working on our software upgrades. Those are efforts that are now ongoing. We're also upgrading some metering on converting currently non-participating units to make them participating. We're hoping to have all that work complete by November of 2025. So there's quite a bit of effort going on there. The positive news on some of these metering is that the supply chain issues seem to have, in the relevant components, seem to have enhanced or seem to have gotten better. And so this is less of a stressor for us as it was previously. We mentioned with the CAISO integration work stream for us, the implementation agreement, and we are working on developing milestones and timelines that will need to come out of the work with our vendors who are developing the detailed scopes and timelines for us. So that is an ongoing work stream that we're hoping to have completed here in the next month or two, but we're a little bit dependent on some of that all coming together. But again, work with the CAISO team is going great. And then, of course, there's quite a bit of communication going on, both internally among other entities interested in EDAM potentially. And we're going to be giving an update also as part of the WEIM forum on May 30th, as well as have a lot of other communications with potentially interested parties, and are trying to devise ways to efficiently inform and share some of our experiences, recognizing that our experience may not be fully representative of what other entities might experience. Next slide, please. So really quickly on next steps for us here, just even before the summer and in the next quarter, really, I've mentioned this already, we're having to really get all the contractors and all the vendors under contract and figure out all the detailed interdependencies from a technology and staffing perspective. That is, of course, very relevant for the CAISO as well. So we can jointly figure out how to orchestrate all the various testing requirements and just all the various work streams that are needed. I spoke already to the OAT development process. Perhaps the only thing I had not mentioned, we're planning on filing with FERC by November 2024, or at least by the end of the year. We have quite a bit of work to do to get there, and of course, proper stakeholder process as well. And other than that, for internal readiness and project management, we're finishing our onboarding and bringing in various consultants to help out on very technical items and to support our internal staff. And other than that, I think everything else I've already touched on. I'm happy to answer any questions, but wanted to be mindful of everybody's time. So thank you.
Thank you, Kristen. At this point, let's go for questions or comments from the board or governing body. And Mary, I see you have your hand up.
Well, I just wanted to express my gratitude for the fact that you're going first and that you made it possible. You're the cornerstone, basically in this new market. And I think we can't say enough about that, because this has been so many years in the making, but somebody had to actually bite the bullet and agree to do it. And I think once you did that, I think you gave us a lot of optimism that this was the right thing to do, and also to encourage our balancing authorities in California to participate. I thought that was critical that we have participation out of California also, but nothing beats the first one. So congratulations, and thank you for going first. And this has got to be a lot of time and a cost to you and your organization. And you're right, it could be choppier, it could be less elegant, but it's, you're the pioneer. So please let your management know how much we appreciate it, and we understand how important what you're doing is to our overall success. So thank you.
Thank you. Appreciate the comment. And we like to say it's character building. So thank you.
Elliot, you have your hand up?
Well,
Christine, I just wanted to also congratulate you. I know you just stepped into a new position as the managing director of Western Market Policy and Analysis of Pacific Core. So congrats to that, amongst all of the other things on your plate. Really do appreciate your leadership. And I totally agree with Mary that, you guys kind of stepping in, raising your hand, going first. It's going to make everything better for everybody. So thanks again, and really appreciate the collaboration with our team. It's a great job.
Thank you, Elliot.
Thank you, Elliot. Silas, are there any comments on the line?
If you would like to make a comment, you can press the raise hand icon on Zoom or #2 on the phone. No comments on the Zoom or phone at this time.
Thank you, Silas, and I see no more hands up. So at this point, we can move to agenda item number 7, which is the briefing on load conformance, including residual unit commitment adjustments. And to introduce the topic again, Vice President, Market Design and Analysis, Anna McKenna.
Well, thank you so much, Roger, and good afternoon again. We are here today to give you a briefing on load conformance practices as well as residual unit commitment adjustments that we make from an operational perspective. But of course, there are lots of implications to markets with regards to these themes. And so we've been asked to provide a little bit of a background and educational element to this, and also some previewing some of our practices and practice changes that we have adopted over the years, and particularly most recently. And we hope that this stimulates a good discussion and dialogue. There's no decisional item here today, so no hard questions for you all, but we are looking forward to your hard questions. And I will introduce Guillermo Bautista Alderete. He will provide you a walkthrough of the presentation.
Thank you, Anna, for the introduction. Members of the Board of Governors and of the WEIM entity governing body, good afternoon, and thank you for the opportunity to provide this briefing on load conformance. This topic has become of interest in the recent months, given the observed trends and specific changes that we have implemented to the processes that we have in place to guide the adjustments. The material is presented in 2 parts. The first one is related to the why, how, when the load conformance is used in the markets. And the second part is an associated item regarding the practice that we implemented after the July emergencies regarding the limitation of transfers in the EIM market for the CAISO balancing area. The material is quite dense, and I would be glad to address any questions and comments you may have throughout the presentation. Can we move to the next slide, please? Let me start first with what is load conformance. Typically, we also refer to this as load bias. The operators have a variety of tools to be able to manage the system through the market. Load conformance is a tool available to any operator in the EIM market in which they can effectuate a change to the load forecast. The load conformance is no more than applying an adjustment to the load forecast that is going to be used to clear the market. It's going to influence how much supply we have to effectuate in the market clearing process. The load conformance can be positive, meaning we are asking for additional demand to be met with supply in the market, or negative. We can reduce the amount of supply that is going to be cleared in the market. In the illustration in this slide, you have 3 sets, one in the morning peak, another one in the evening peak with a positive load conformance. The effective load requirement that we are asking the market to clear at is the dotted line that is above the natural load forecast. That is the requirement that is going to lead to a specific supply mix when the market clearing is taking place. Next slide, please. The load conformance is available to any operator, and there are different ways to apply that across the different markets. First, there is a feature that is available for any market in the CAISO. Specific to the day-ahead market, this can be applied to the process that we call the residual unit commitment. That is a reliability process in the day-ahead market. This doesn't apply to the market power mitigation process or to the financial market, the integrated forward market, because these are based on bidding demand. It is only the ROC process that utilizes the load forecast, and therefore it can be adjusted up or down. This load conformance can be applied on an hourly basis. The operators have the flexibility to determine in what hours and by how much that ROC adjustment is going to be applied. When we move to the real time, the logic is similar. Each real-time sub-market, the hourly process, the 15-minute market, and the 5-minute market can have a load conformance in the applicable intervals, 15 minutes for the hourly and 15, and 5 minutes for the real-time interval dispatch. When it comes now to the way the operators determine how much conformance has to be applied to each of the markets, the logic is different. For the day-ahead market, currently we have evolved the guidance of the ROC adjustments to be based on what we call the net load uncertainty. The idea is to ensure that the ROC adjustment is going to be able to cover the uncertainty related to the movement of load, wind, and solar when we go from the day ahead towards the real time. There are other conditions, operational-wise, that may pose operational risks, and for which the operators may still be able to use ROC adjustments. A typical case is when we have an event projected to happen, a fire threatening a transmission line, a potential or likely outage of a generator. These are the operational conditions in which there could be additional ROC adjustments on top of the net load uncertainty adjustments that we are using. When we move to the real time, the logic is different because in this case, it's fully based on the assessment of the system operator based on the projected and current system conditions. Next slide, please. Now let me go into the why we need to use load conformance. And this is really a whole discussion on its own. Through the analysis and effort that we have taken to assess the need for the load conformance, working with our operators, we have identified so far 10 different reasons and drivers for which there is a need to utilize load conformance. I will not spend time going through each one of them. If there is any specific question, I would be happy to go deeper into each of these 10 elements. The bigger picture here is that operating real life on real time, the system is a complex task. There are many dynamics inherent to the conditions of the real time that the operators have to factor in all together to assess how they are dealing with the current conditions and the projected conditions. There are cases in which they have to make a determination a priori because that is the last time they have to be able to influence the market solution. If they pass that window, it's too late. They may have to incur now in other type of manual actions to be able to try to get back on course. And there are many other dynamics that are beyond the control of the operator, such as resource deviations. These are actions that are going to influence the balancing of the system, and the operators have to be ahead of the curve to be able to position properly the resources for all these conditions that are coming all together. These are not mutually exclusive conditions. They may happen actually concurrently. And this is part of the complexity. The operators have to really assess, based on all these moving pieces, what they need to be able to properly position resources toward the balancing of the real time. I would say that the load conformance is a tool available, and this can be considered to be the last resort approach in which they are able to bridge or the mismatch between what is actually happening in the system operations versus what the market is projecting or assessing to have based on the best information that the market has at the time it's running. Here is where the timing and latency can become critical. Our first market of the real time runs 75 minutes in advance. That is the time when we have to take and lock all the inputs that go into the market, such as the load forecast, the wind and solar forecast. And 75 minutes in real time is a long period of time in which conditions are bounded to change. These are the type of challenges that are facing our operators to be able to rely on this tool as the last mechanism to balance the projected conditions. Next slide, please. The motivation to use the load conformance, even though we have these 10 different reasons, are slightly different for each of the markets. When we go into the day-ahead market, the ROC adjustments, the primary purpose of these adjustments is to ensure that we have committed sufficient capacity to be able to meet our projected load forecast, plus the net load uncertainty that can materialize for going from the day ahead towards the real time, when we have load, wind, and solar moving between these time frames. As we move into the real time, the motivation is different. Now we're operating in real time. There are some decisions that have to be made as a last opportunity. And the primary goal of the real-time load conformance, specifically the hourly and the 15-minute processes, is to ensure that resources are properly positioned for us to have the amount of needed supply available, but most importantly, that supply has the speed to be able to meet the ramping and the variation that is bounded to happen in the real time. This is the ramping capability that we need to ensure that is in place. And as we move closer to the balancing of the system, the 5-minute market, now we have to deal with basically the moving target that is just keeping the balance of supply and demand. This can be as frequently as every 4 seconds. Operators have to make a very quick projection for the next 5 minutes, where they need to be in terms of their frequency, their control aromatic error, the ACE, and overall the total balancing of the supply and the demand. These are the 3 main areas where the load conformance is going to be used, given these specific nuances of each specific market. Next slide, please. When we apply the load conformance, the expectation is that this is going to influence the mix of the supply that is available in the system through the market. The load conformance is going to influence that solution, but the market at the end, based on the overall supply mix and the overall economics of the system, is going to determine how that additional load conformance is going to be met. And there are different ways how that conformance can be actually met. On one way, the additional load can be met by bringing additional import transfers. Or if that area, like CAISO, is actually getting export transfers, it can actually reduce those exports. There could be cases in which the market determines that the best way to meet that additional load conformance is to commit additional resources. These are actual physical gains of supply for the operator. There will be resources that still have some headroom, and they can move incrementally up to be able to meet that conformance. If we're talking about the hourly process, that is our last process to be able to secure additional hourly interties or reduce and rebalance the hourly exports, this could be the case in which the bias and potentially how many hourly exports we may be able to reduce to balance the condition. And when we are in a very tight situation, most likely part of that load conformance is going to be met by being infeasible. Simply, there is not enough supply, there is not enough of these drivers to be able to meet all the available load conformance asked by the operator. These signals that we are in a tight situation, and the market infeasibility is effectively telling us by how much we are going to be short of supply for that time frame. At the end of the day, how much is procured through each of these mechanisms is fully predicated on the economics of the real-time market. Next slide, please. Let me now go into a little bit of the history of the utilization of the load conformance. This first trend is about the day-ahead market, specifically the ROC process, and how the adjustments that we have utilized for that process have evolved over the years. And this gives you a sample of the last 8 years so far. And this is important to realize time-wise that during this period of time, there has been significant changes to the system, to the generation mix. We have high penetration of behind the meter and solar and new technologies such as storage resources that give us a different reference of how we have to operate the system. Not surprisingly, over this year, you can see that there is a different trend of how and how frequently and how much we have utilized the load conformance in the day-ahead market. Just to point out key points in time, back in 2017, the ROC adjustments were fully based on operator assessments, on the judgment of what conditions they projected to have in the next day. This is a typical distribution plot where you have boxes capturing half of the sample of the month or the hour or the year. And there are some dots that stand for the outliers, statistically outliers outside this distribution of the box. And the highest value you can see is effectively the highest value that was ever used for that specific point on time. Back in 2017, you can see that we have few points, outliers, under 2,000 megawatts. And then as we progress over the years, you start to see that there is a better sampling, better distribution of these adjustments, mostly concentrated in the peak ramping hours of the afternoon. Back in 2021, we realized that we could provide better information to the operators about the uncertainty that they were facing about load, wind, and solar. And we start providing these confidence bands of potentially what would be a worst case scenario for load movement, for solar and wind movement. In 2022, we realized that giving these separate confidence bands and just summing them up together may end up in using a guidance that was too high. And that is the reference that you have in 2022. The highest value that we use so far for load adjustments that happens to be in the summer of 2022 was about 10,000 megawatts because of this compounding effect of the different confidence bands. That is when we determined that we wanted to have a more sophisticated, more statistically based calculation to get better guidance to our operators of what potentially could be the integrated uncertainty for the net load as a whole, rather than piecemeal for load, wind, and solar. And that is the reason that effectively at the end, in the middle of 2023, we implemented this programmatic calculation that is using a similar methodology that we're expecting to use for the day-ahead market enhancements for the feature of imbalance reserves. And since then, since July 2023, we have been assessing and tuning that methodology to ensure that we are calibrating properly to measure the uncertainty that we have and the risk, the operational risk that the operators are facing to determine what is the right level of uncertainty they want to cover given the conditions they are dealing with at the specific point on time. As of 2024, we have further improved that logic, and you can see how the distribution, the magnitude of these ROC adjustments have changed. Effectively, they have reduced after we have further tuned that methodology. Next slide, please. The last 2.5 years are kind of more critical to assess how this has evolved. Sorry, I think there is a question from Anita.
Yeah, so Guillermo, if you go back to the last slide and you talked about improving the logic, what's the next iteration of improving the logic?
Yes, I have a slide specific to that, Anita, two slides down the presentation. If you don't mind, I can try to answer that at that point.
That sounds good.
Thank you. Okay, the last 2.5 years have been more relevant to the evolution of our process to assess and guide the adjustments for the load conformance. This captures key critical points in time, and the reference is the heat wave of the summer 2022. That is when we have a heavy use of the load conformance. These are daily averages over time. Starting in 2023, we have a deliberate effort to start a pilot program to assess all the factors that you have seen in a previous slide to understand why we have to use this level, that frequency of load conformance. And the blank space that you see between the May and June of 2023 is not that we are missing data, it's actually that we didn't use any ROC adjustments for that period of time as part of the pilot program. We really wanted to understand what was the implications of not using the load conformance, how bad situated and the resources were towards the real time, And that provided very useful information for us to assess really the challenges that our operators are facing. That is part of the reason we are able to identify these 10 reasons that I described a bit earlier in the presentation. And then starting in July, we moved towards this programmatic calculation of the net uncertainty using this statistical approach. It's a regression approach. And that was just a programmatic calculation. And you can see that we start getting into higher levels of rock adjustments. For the summer time frame, that is relatively expected. But as we move away from the summer and get into the winter, we continue to see these high levels of the rock adjustments. That is when we start assessing the implications and adjusted the logic accordingly to reflect the level of risk that we are dealing with for non-summer months. Effectively, on December, we adjusted that logic, resulting in lower levels of rock adjustments. And more recently, in May, we also do another level of adjustments that further reduced the level of adjustments for these non-summer months. Next slide, please. What were the main drivers to have the continuous need to assess the effectiveness of the methodology that we implemented back in the summer of 2023? This very quickly became very evident through the settlements implications. In the upper part, you have a comparison of the trends of the rock adjustments that we use for the last quarter of 2022 versus the months of the last quarter of 2023. Just to give you a perspective how the profile of the rock adjustments changed between years after we implemented the methodology. And there are some salient points that you can see from this trend. First, now there is a rock adjustment that applies to every single hour of the day. There is this well-defined morning and evening peak. There is still a rock adjustments in the middle of the day. And that actually has a lot of implications how the rock process is going to commit resources. Effectively, that changed the way the rock process was committing resources because it's different when you need to have a resource committed to meet a couple of hours in the peak time versus having resources that have to support a rock adjustment across all 24 hours. Effectively, specifically for the Q4, we saw that less flexible gas resources were committed to be able to meet these incremental rock adjustments, unlike what we have in the previous year. And that has cost implications because anytime we commit a resource that is less flexible and it can only be committed through the day-ahead market, there could be implications of make-whole payments. If that resource happens to be not in the money for the period that is committed, we have the mechanism as part of the settlements to ensure that they have the bid cost recovery, that is additional cost to the market to ensure that they are made whole. That was the best reflection of the implications of this level of rock adjustments that we have. You see the trend in the lower plot. The portion in green reflects the bid cost recovery associated with the rock process. These are coming from the units that were committed in the rock process because of these additional rock adjustments. You make a gross summation for the last quarter, we are talking about potentially an extra cost of $30 million. And this was part of the motivation to keep going into the further tuning of the rock adjustment methodology that we have. Next slide, please. What we have done since then, there has been at least two changes. One happened on December 2023. We move away from the full net uncertainty provision that is estimated at the 97.5 percentile to use a logic that is more based on system supply and not only weather conditions in California ISO, but across the West. That resulted in lower values of the rock adjustments. And then more recently, on May 7, we did a further tuning to the logic, and effectively, that is resulting in lower values of the rock adjustments. These are predicated on the conditions that we are dealing as of now that are non-summer months. This is an ongoing effort that we have to consider how this is going to evolve now that we move into the summer conditions. And when we have implemented these changes, we have a way to communicate that to the market and to the community. There is a public operating procedure that provides all the guides about how we run the day-ahead market. That is the procedure 1210 that is publicly available and that is updated every time we proceed with that change. In addition, for transparency, previously we have going through the effort to ensure that the ROC adjustments, similar to the real-time adjustments, the load conformance, all that is publicly available through our OASIS system. Participants are able to see what we are using for each of the markets at any time. Next slide, please. In addition to the day ahead, we equally focus on the performance of the real time. They are equally critical to ensure that we have the handling of the conditions for the load conformance utilization. And they were also part of the pilot program for 2023. And similar to the trend that you saw for the day ahead, this shows you the trend of the load conformance on a daily average over the last 2.5 years. The reference point here again is the summer 2022 when we have these challenging tight supply conditions. That was the highest level on average that we have for this window of time. As we went through the pilot and we worked with our operators, we were able to isolate and control the conditions to be able to effectuate lower and lower load conformances in the real time. And that is the reason you see that decrease that was quite marked during the period of June, beginning of July. Then we have the emergencies of 2023 that happened starting on July 20, going through July 26. And that is when we reset the expectation to go back to a more standard conditions. We got the value of that pilot program, understanding what are the drivers, and now we are pursuing each of those drivers. Next slide, please. Let me move now into the second part of the presentation that has some association with the load conformance, and that is the dynamic that we observed when we were dealing with the emergencies of July 2023. We have, as part of the Western energy imbalance market, the capability to have economic displacements between balancing areas. That is by means of the economic transfers. When there is cheaper generation in one area, that generation can flow into another balancing area by means of the transfers to displace more expensive generation. That is economics at play. Each of the markets that we have in the real-time market optimizes all the supply across the wider footprint. And that implies that each of the market is going to come with expected projected transfers that are going to be applicable for that specific market. When we go from the hourly process to the 15-minute process to the 5-minute market, these transfers are in nature advisory. That means they are estimated, they are optimized in the hourly process, but they are redone, re-optimized in the 15-minute market. And then they are redone, re-optimized again in the 5-minute market. Therefore, the hourly and the 15-minute transfers are advisory in nature because they are subject to change as the conditions of the system change. What we saw in the July conditions is that in the hourly process and in the 15-minute process, we were projecting to have healthy levels of transfers coming into the ISO such that we can assess how much of our own internal supply we needed to meet not only our own demand, but also the levels of export that we could reliably support. The problem is that once we go from the hourly and the 15-minute market towards the 5-minute market, a large volume of these transfers didn't materialize. However, we now are locked with the level of exports that we have to clear because they were predefined already in the hourly process, and we still have to meet our own load. That unrealized transfers poses a challenge because now it's a loss of supply, effective loss of supply to our system that the operators have to figure out how to deal with that just in the last minute. And when we saw this starting on July 20, we continued to assess how that performed over the next days. And we realized that that was a persistent trend that was quite critical during these emergency conditions. Next slide, please. This summarizes effectively the unrealized transfers from the hourly and 15-minute markets towards the 5-minute market. A positive value in this case means that these were transfers that were projected to be available and they were not longer available in the 5-minute market. It was a loss of supply for the CAISO balancing area. And that is the reason when you see that that amounted over 3,000 megawatts at some point on the day, that was too significant to keep going with that approach. So effectively, starting in the evening of July 26, the CAISO started to limit the dynamic import transfers into the ISO area in order to assess more precisely what is truly the supply that was available to meet our own demand, plus how much exports we were able to reliably clear in the hourly process. This practice was very targeted in different dimensions. Can we move to the next slide, please? And here are the specifics of that practice that we implemented starting on July 26. First, that was very surgically applied only in the import direction for the transfers coming into the ISO area. That limitation did not apply to the export transfers, meaning there was still all open gates going from the CAISO into any other area that would need that power to flow as an export. The limitation applied to what we call dynamic transfers. We have also static transfers, and these are basically optimized in the 15-minute market, and they are held fixed into the 5-minute market. They don't pose a risk because they are already fixed. It's only the dynamics transfers. And more importantly, it was for the critical hours that covers the gross peak and the net load peak. Depending on the time, it could be around hour ending 19 through hour ending 21. The limitation was also very targeted for the hourly and the 15-minute process. Once we could get the right picture of the available supply that was available in that projection, we didn't apply that limitation to the 5-minute market. The imports and exports could freely flow in and out of the CAISO in the volumes of the economics deemed to be appropriate. And the last piece is that this was a limitation applied only to the import transfers. We do have hourly import transactions. They were not limited in any fashion. There is an ongoing concern about this practice, about the timing that we implemented this practice. We started in July 26, and it lasted past the summer, way into the November timeframe. The reasoning for keeping this practice in place was because of other operational risks that our area was facing. As part of the analysis and investigation that we did for the July emergencies, we identified that there were at least 3 major challenges that our operators were facing when dealing with these emergencies. One of them is that there was an issue with the visibility they have in terms of how much ramp capability they have access. That was not accurate, and that was not giving them a good reference of fully awareness of how much capability they have in the system. The second piece is that when we reached the tight supply days, part of the hourly process was to assess that we couldn't afford to clear all the exports that bid into the system. We were in the range of 5,000 megawatts of export reductions. When we see how much of these exports actually came into the system, a half of those didn't follow the reduction instruction because of some ways we have implemented the logic in our tagging and approval systems. That was still an open uncertainty that the operators have if they were instructed to follow certain reductions and they didn't materialize. Effectively means tighter supply conditions to deal with in the real time. And there was another factor that impacted the modeling of specific intertie injections in the system that eventually impacted how the congestion was played in the system. On top of all this, there was heavy congestion in the system, and this last issue further exacerbated that condition. These 3 issues together posed greater level of operational uncertainty for our operators, and therefore wanted to have as much certainty of what supply was really available to be able to meet our own demand plus the exports was the motivation to keep this practice until all of these three main issues were addressed. They were addressed eventually by November 16, and that is when we stopped the practice of the limitation of the transfers. Next slide, please. The limitation of the transfers is a feature that is available not only to the CAISO balancing area operators, it's available to every other operator that is participating in the WEIM market. And indeed, different balancing areas have utilized that feature at different times to handle the conditions they are dealing with. The action of limiting the transfers did have implications for the market. Once we impose the limitations of the imports, effectively, we are influencing that the demand of the CAISO area has to be met mostly with internal resources. And that means it's going to, in some cases, create price separation, higher prices in the CAISO because we are limiting ourselves to bring additional supply from others through the transfers with lower prices somewhere else. That is going to effectively means it is the CAISO area that is going to see the effect because now it's going to have higher prices. The load in the CAISO area has to pay that higher price. If there is congestion creating this price separation, indeed, the congestion cost resulting from this limitation is allocated 100% to the EIM entities. And having this certainty of how much supply we can actually rely to meet our own demand and the levels of exports provided not only the certainty for the CAISO, but also to the other entities that were potentially relying on exports to ensure that they have more certainty that eventually they can be supported and they can flow. The conditions of these advisory projected transfers not realizing eventually in the 5-minute market may still happen. There is still part of the market mechanism that we have. So we may project that these are conditions that may arise again, and we do have the ability, like any other EIM area, to be able to apply those limitations. Given the fact that we have addressed all the lingering issues that we experienced in the July conditions, we are confident that it's going to be in a very targeted fashion if that happens again. And that's all what I have for this briefing. I will be glad to answer any questions you may have.
Thank you, Guillermo. So we have, I want to do a quick time check. Obviously, we're over the initial time, and I don't know if anyone has commitments. Ryan Krolinski is on. We have a spot here for him to give some comment as well. So we can proceed with Ryan and then head to governing body comments, if that's okay. Or governing body and board comments, I should say. Well, hearing no objection. Ryan?
Okay, yes. Good afternoon, governing body and board members. Yeah, can you hear me?
We can hear you.
All right. Yes, this is Ryan Kurlinski from the Department of Market Monitoring. For people listening at home, I'll just give a little background on why we are commenting here. Is we typically don't comment at general sessions on ISO presentations on special topics. In public reports and board memos over the past 5 months or so, DMM has highlighted several of the issues that Guillermo just presented on. So some governing body and board members thought it would be useful if DMM gave a brief update today on where we think things currently stand. At a high level, DMM appreciates the ISO discussing both load adjustments and WEIM transfer limitations here today. More transparency should help participants respond more efficiently in the markets and can hopefully help the ISO develop better solutions. On the issue of RUC load adjustments, DMM has highlighted in reports the large load adjustments in the second half of last year and how that increased costs. The ISO has made some changes, and now instead of just estimating uncertainty between the day ahead and real-time net load forecasts, the ISO is first doing an assessment of other operational risks. Right? This other operational risk will determine if they need capacity to cover only a small amount of uncertainty materializing, or a medium amount, or if they want to cover almost any uncertainty in the day ahead net load forecast that might materialize. So this should help to reduce costs. So these are good enhancements. But going forward, it also highlights how important this relatively opaque assessment of other operational risk is for determining how much capacity the ISO thinks it needs. So more transparency into this other risk, that is, risk or uncertainty over things aside from uncertainty in the day-ahead net load forecast, right? So more transparency into how this other risk determines the RUC load adjustment. We think it help the ISO make further improvements in its RUC load adjustment process. The next on the WEIM transfer limitations. DMM has recommended more transparency on why the ISO is doing this, and when they may limit the transfers this summer. So we appreciate this general session presentation, and our understanding is that the ISO will present even more detailed analysis at an upcoming market performance and planning forum meeting, and that'll be important, right? More public discussion and analysis could help the ISO refine its processes, and hopefully it could reduce how often they limit those WEIM transfers. And stakeholders may be able to help come up with alternatives for addressing the reliability issues that the ISO is concerned about. So we recommend the ISO continue to shed light on its use of these WEIM transfer limitations. That's our brief update. Thank you for your time, and I can try to answer any questions you may have.
Thank you, Ryan. At this time, I'll turn it over to the board and the governing body for questions. I currently don't see any hands, but I expect that to change quickly. Rob, oh, look at that. You guys are quick. Rob, you're first.
Recognizing the late hour, we'll probably be brief here, but I would like to ask a question regarding the day-ahead process. So Guillermo, you identify the issue, I believe, if I heard it all correctly, as being related to uncertainty. And so load conformance was being used to address that. When your analysis was done, was there any discrepancy based when looking at the day-ahead process, or the day-ahead process of any type of forecasting associated with that? Or as you were presenting, you didn't find anything that was related to the process within the day ahead, and it was all more towards the conformance based upon uncertainty and changes.
And let me try to answer this in a way as I understood the question. The evolution that we have for the ROC adjustments more recently is the migration of this operator judgment-based approach towards a more programmatic and calculation-based approach. And the type of risk that we are able to measure with this more programmatic approach is limited to the weather-related uncertainty when there is load, wind, and solar moving. That's the only type of risk we are able to quantify. Now, we use this methodology to assess how much risk, how much uncertainty is associated with the movement of load, wind, and solar. The secondary piece that we have done is that is a starting point. From there, we have to assess the actual operational conditions that the operators may be facing next day, given on a variety of factors. For instance, how much supply, how much headroom we have of supply available for next day. If we are these days operating at, let's say, 30,000 megawatts of peak, and we have 40,000 megawatts of resource adequacy supply, we know that we have a healthy headroom of supply that can be eventually committed, and most likely there is very little risk to have 3,000 megawatts of ROC adjustments. That can still be accommodated through the real time. If there is a critical weather condition event happening somewhere in the west, well, that may be put stringent conditions in the transfers. Eventually, there may be some impact on our supply. We have to assess what is the potential risk that may pose to ensure that we have enough capacity committed to meet that type of operational condition. These are the two pieces that we are putting together. One is the reference calculation of how much uncertainty is supposed to be there based just on statistics, but then match that with the reality of the operational risk of what we are trying to hedge for the given conditions we have.
Gero, thank you. And I appreciate going through this in this level of detail. And I'm just going to echo what Ryan had just previously said, that I think this was a terrific start. And I think, peeling back these layers to understand it are very helpful. And I look forward to being able to addressing this in further detail again at some point in the future as this rolls forward and more information is available. So thank you.
Thank you, Member Robert.
Oh, I'm sorry, I was on mute. Anita, your hand's up.
Yeah, I'm actually going to just send some questions to Guillermo in the interest of time. So there's a few things that did not get answered, but I'll just wait for a response from him.
Okay, thank you. Appreciate that. Andy?
Well, I'll continue with the theme. I have questions. I'll ask them at a later time and place. But Guillermo, thank you so much for the presentation. It's very responsive to what we were looking for in terms of educational presentation. I think this is an issue where transparency is very helpful. So I look forward to that, transparency and scrutiny and analysis continuing. But thank you very much for the time you put into today's presentation.
Chair Campbell, I'll just offer up on behalf of all of us. We, first of all, really appreciate the DMM's engagement on this topic. It's really helpful. It's another good driver for us of the transparency that you're talking about. And I think just continue to work with all of you to sort of unpeel these issues and continue to make process improvements, transparency improvements, and bring automation and discipline. So appreciate the briefing by Guillermo and the conversation today.
Great. We do have on the agenda for public comment. I don't see any at this point, but Silas, can you just double check to see if there's any public comment on this item?
If you would like to make a comment, please press #2 on the phone line, or you can press the raise hand icon on Zoom to enter the comment queue. There are no raised hands in the comment queue at this time.
Thank you, Silas, and thank you, everyone. Our last agenda item is informational reports, which is on the agenda. Just as that, there have been reports submitted to the board and the governing body, and this is an opportunity if you have any questions on those reports. Okay, seeing none, I want to thank everyone, and at this point, we will adjourn the meeting. Good job. We only were half.
Good meeting. Appreciate it.
Thank you,
Bye, everybody.
Thank you, Andy.
Thank you.
Bye.
Thank you.
All right. Cheers.